Good morning, everybody. Welcome back to another episode of The Market Open. We are live. Thank you all for being here. It is Friday, August 28th. I'm tired, bro. It's just been one hell of a week, and I am tired. We got Kevin Warsh speaking today. I don't know when he's speaking. Some people say 11:30. Some people say 12. We're going to see what time he ends up going live. But we're not going to do a market close today. We're just going to have a very extra long market open because we will have Kevin Warsh, and we will be taking a look at what he says and, quite frankly, how the market reacts to it. If it is at 12, then we'll be live going into that talk. It might be a 30-minute talk, might be a 20-minute talk, might be an 8-minute talk. S&P 500 right there. 772. That is green in the pre-market. So far, the broader market is expecting the talk to be rather positive. Oil is down in the pre-market, which is also good. But if the inflation expectations are not that, exciting, or at least not as aggressive to the downside as the market has been expecting, then I don't even want to say the market could, tank today on Kevin Warsh being hawkish, because I feel like that's priced in, but I also don't know if the market could rip up if Kevin Warsh is dovish. So it's one of those Jackson Hole meetings where we're not really sure what he's going to say. We don't even know if he's going to say anything meaningful, because he's the type of guy that doesn't like to give guidance. But nonetheless, it will be important, and everyone's going to be listening to what he has to say. So this will be an important one. Yeah, Derek says you're definitely tired. You can feel it in the energy. Dude, it's been a long week, man. It's been a long freaking week. My hair's messed up this morning. Put on the hat. It's just like, you know what? It's been a tiring, volatile week with NVIDIA. I really feel it in my voice too. Like I've been eating cough drops for like the past 2 days, because I don't want to say my throat hurts, because I know what the comments are gonna be like, but my throat genuinely hurts, dude. And I feel like it's just all the yelling over the past 4 days, really from Monday to Wednesday. I think after NVIDIA earnings is when I really started feeling it. And then yesterday, I told myself I wouldn't go crazy in the market open, and I just started yelling again. So today I actually need to keep my my throat clear and not as aggressively yelling. I drank the green tea. You guys can say drink tea. I did all that stuff, but I think at some point when you're talking for 7 hours a day, 3 days in a row intensely, because there's just so much going on, by the end of the week on Friday, that's when it kind of catches back up to you. So we're going to try to take it a little bit slow in terms of the yelling, but there's still a ton of stuff to talk about. We had Iran earnings yesterday, Marvell, we got Kevin Warsh. Gap is up 17% for some reason, even though Marvell's down 7%. So I guess the market made their choice on where they want to deliver the gains today. So we'll talk about some of those earnings, and we'll keep going from there in terms of what's going on with these Iran updates as well, which is also, starting to be a little bit more aggressive as bond yields are taking a bit of a hit, but there's no formal resolution on what exactly is happening here. Yes, Rocky is a Indian holiday that is between brother and sisters. It's like the brother gives a sister a gift. I'll be celebrating that tomorrow with my sister, even though today is Rocky. So happy Rocky to anyone who celebrates. But yeah, I'll be seeing my sister tomorrow. UPS hat kind of day. Exactly. It's a UPS hat kind of day. Gap is gapping up. That is correct. Gap is indeed gapping up. Zitron was on Diary of a CEO. He was on the Compound today, bro. This guy is... I haven't watched the Compound episode. I hope they push back. It would be nice for them to kind of push back on some of his claims. So there it is. Maybe we can see some clips from that and see if Josh Brown can kind of just contest some of these arguments. But yeah, he has been making the rounds on a lot of these different podcasts. All right. Good morning. Good morning. Good morning. Thank you all for being here. Mike, what's up? Treya, good morning. Shree, thank you for being here. Tess, thank you for being here. Tesla Granny, good morning. Good morning to you. Nasir, what's up? Mick, what's up? Sid, thank you for being here with all the rainbow emojis. It is what it is. Drink some lean. That is that is an interesting suggestion. I've never done that before, but thank you for the advice. B-Sob, what's up? Good morning. Good morning. Is everyone else tired? It just feels like one of those Fridays where you wake up and you're like, man, this has been a hell of a week. And as long as Warsh doesn't mess things up today, which I don't think he's going to, but then again, who knows? I think we'll be okay. NVIDIA had its best day ever yesterday. $453 billion in market cap added. At one point, it was $480 billion in market cap. It's still below where it was last Tuesday, but it seems inevitable at this point. NVIDIA is going to break over 230. It was at 230 for a little bit yesterday. Then it kind of sold off into the close. You had some semiconductor earnings that were really good, but the market didn't love it in terms of price action with Marvell and Iran. We'll talk about those. I don't know if Kevin Warsh really says something that takes NVIDIA back down to the low 220s, but if it does happen, then it is what it is, and we're going to see. Yes, I saw the PayPal news as well. We'll talk about that. Rubrik also had a monster earnings, like amazing numbers. Stock was up 10%, then it ended up falling 10%. Now it's down 4%. But a lot of these names just had, yesterday I think was, I don't have the numbers on it, but I think it was the best day for software in 2026. It was like, it had to be one of the top 5 days for software in 2026. Salesforce, CrowdStrike, Palantir, like all of these names just breaking to new 52-week highs. And it seemed pretty obvious that SaaS is now back, which is a good thing, but hopefully we can continue to see that momentum going through. All right, let's get started. Thank you, everybody, for being here. Thank you for all the support this week with the Wall Street Journal and NVIDIA earnings and all that stuff. It's been an exciting week, but we still have an entire Q4 to go through. August 31st will be the last day of trading, so that's next week on Monday, and then we're in September, and then we end out 2026 and get ourselves ready for 2027. All right, so let's start with the earnings from last night. I think that's, well, actually, let's do this PayPal news. So PayPal's down 14%. The reason PayPal's down is because Stripe has pulled out their offer to bid for them. It's so funny because when Stripe put in the offer, the stock went up, but everyone knew they weren't actually going to buy them. And I don't think people were buying PayPal on the arbitrage of if Stripe would end up buying them because there just wasn't enough juice to the news. The news was real. Stripe probably wanted to explore the acquisition, but they ended up buying OpenRouter, which is an open source platform for AI models, for $7 billion instead, which is probably going to do a lot better for them in terms of getting that API out into the world versus another payments platform. So yesterday, when the news came out that they are pulling out from wanting to even bid for PayPal, immediately the stock collapsed. And PayPal is one of those things where I think the numbers are pretty bad in terms of growth, but the numbers are not horrendous in terms of a company that is not stable, right? So maybe you're not seeing 18, 15% growth, but you are seeing like 4 to 7% growth. And as a stock that like theoretically has bottomed, now it's hard to say that because they've had leadership changes. There's a lot of inconsistencies in terms of how the company's offering. Bitcoin, by the way, below 80,000 again, 79.4. But it's not necessarily the one I want to go bottom fishing on. But it is one that I think will eventually be acquired or have an activist investor come in. So the question is this 15% drop the opportunity to get in before a situation like that happens? And time will tell if that's the case. But 61.40 down to 52.50 as now the acquisition offer has been taken away from Stripe. And it's going to take a while to see who else gets excited to buy PayPal here. So Marvell and Iran, I think those were the big 2 stories last night. Let's talk about those, and then we'll get into some of the other kind of earnings that we have. So first of all, Marvell crushed it. I think the problem with Marvell here, and there was no real fundamental problem with the earnings. We listened to a little bit of the call last night. Down 7%. Guidance was a little bit lower than expected. If you had to nitpick, you could nitpick around that. But I think the core thing around Marvell is that this is a stock that has done incredibly well this year. This is a stock that Jensen has praised. Year to date, the stock is still up 170%. So it's one of those things where it's like a Nebius or a Micron. If they go down 10 or 15%, you just zoom out year to date and be like, okay, most of their gains happened from January to June. And whatever it got to in July was a bit euphoric. It is consolidated down from that, but it's not consolidated at all down to those January, February, March levels because it's still up. All 3 of those stocks upwards of 150%. So it's one of those things you just can't complain about. The actual earnings themselves were great. They beat on the top line, beat on the bottom line. The beats weren't like massive. And again, the guidance raise wasn't massive. There was only beats by about 1%. Revenue growth is still up 37% year over year, which at a company at their scale, that's pretty incredible growth. And then EPS up 40% year over year. But at the end of the day, it was priced in. And I think that's okay to say, but you didn't get any like red flags or something that's making you wonder what's happening with Marvell. Obviously, Jensen called them a $1 trillion company because of how much work they are doing in the optics space. And it doesn't seem like that's slowing down, especially given the NVIDIA guidance. Like every time you start to think, okay, are the picks and shovels a little bit too exuberant or euphoric? You just remember, wait a second, NVIDIA is going to grow 70% next year, which is actually probably 80%. They're likely sandbagging because of their supply constraints, which means Marvell, Micron, neoclouds, they're all going to get the benefit of that NVIDIA growth. And, that probably makes them more of an opportunity than not. So then you have Iran. I think this call was a little bit more disappointing to some of the Iran investors. I think there was a lot of chatter on X last night about the lack of transparency on this call. Stock's down 5% right here. I think the biggest issue is the street wanted a really big deal and they did not get it. They did get the verbiage that there is a frontier AI lab that signed with Iran for a multi-year deal, but there was no details on how many years, who's the lab, and how much money is associated with that. And so, look, at the end of the day, even some of the biggest Iran bulls on X yesterday were like, I'm not sure why they're not disclosing the name of this frontier lab. A lot of people are saying it's Anthropic, but a lot of people are wondering why they can't say the name. You might get into NDA, negotiations terms, yada, yada. But then you see all these random neoclouds saying, oh, we have a deal with Anthropic, right? So it's like companies that are much smaller than Iran are disclosing these deals. And you would think that you would want to have that disclosure out there into the world. So the actual earnings themselves were not that bad. The monetization of megawatts, 25 million per megawatt, I thought was actually pretty strong. And, the guidance they were giving on how that's having a trajectory to grow was also really good. It's not like the actual core business is not doing well or the trajectory of growth is not there. It's the lack of progress, which is really just a question of patience more than anything else. And patience is a question of, do you trust the management more than anything else? And some people do, some people don't. If you do, then you sleep like a baby. If you don't, you start to wonder when you're really going to start to see that level of growth start to inflect in a more meaningful way. And I think that was the broader issue. The call itself, I mean, this is the second time I've listened to an Iran's earnings call, and it was just a little weird that the first 30 minutes were them explaining how data centers operate and literally reading word for word off PowerPoint slides. It got to the point where the CEO wouldn't talk unless the operator moved the slide to the next slide. And it's one of those things, like it was so rehearsed, it was so calculated that they had to read everything on each slide that it was just incredibly boring to me. And it just felt like there was no real passion or energy or excitement for the business. Having said that, that's more of a personal thing that I didn't like. That's not really a bear case for the business, but it definitely, when the stock's falling 7% and there's no big deal announced and you just see the CEO reading off a PowerPoint, people aren't the most excited about something like that. So I think thesis is intact. Execution is still a question. Execution supposedly happened yesterday with no details on that execution in terms of the deal, the time frame, or the level of money associated with this frontier lab that was announced. And so until you get those details, then I think you're just going to have to see what ends up happening. But I ran right there. That is down 5.7%. And then all the semis kind of started falling last night as well. So I think they kind of just reported on a day where the market wasn't the most excited. Micron right there, that's down 1.3%. You've also had a ton of the memory names take a little bit more of a beating. The other thing with memory is your boy Nikesh from Palo Alto Networks is starting to tweet more of his opinions on what's happening in this AI revolution. Yesterday, he said all the neoclouds are basically going to be bought out for less than what they're raising at in a year from now. Yesterday, he said all supply constraints over time have to equate where an excess profits are made in a category, all innovators arrive, cheaper production, technological innovation, etc. All upstream innovation begins to focus on optimizing usage of expensive components. Memory and semis have been cyclical. It seems we are in a never before seen super cycle. Super it may be, cycle it will be. When? Not smart enough to call. I mean, I kind of agree with him. All of this stuff is cyclical. You just don't know, including NVIDIA. You just don't know when the cycle ends. But the beautiful thing about NVIDIA is they have a moat, whereas some of the other cyclical parts of the semiconductor complex don't really have a moat. They have pricing power. And so I think from Nikesh's perspective, it's like, hey, when this stuff catches up, which is what we're trying to do, quite frankly, with memory, trying to create a lot more supply, which is putting the memory makers in an odd spot because they don't necessarily want that much supply because it turns their pricing power. That's why I think these stocks have been relatively stuck. Having said that, the caveat is even with that assumption being true, the memory stocks are still too cheap on a forward basis if you believe the cycle will last way longer than expected. It's not going to end in 2028. It's going to end in even 2029 or 2030. Micron should be closer to a $1,500 stock. So I think the memory names have just been stuck based on that idea of the market realizing, this might be as good as it gets in terms of the pricing power. The other whole issue is, again, Micron, was at $100 a couple years ago. Now it's at 900. It's given you that 10x. And so the sort of sexiness and appeal and like volatility and the Korean degenerate behavior on the memory names, that has died down significantly since the Leopold acquisition. Or not acquisition, liquidation. And I think that is also, people have started chasing other stuff. Crypto being one of the big things that people have rotated into. So the thing about momentum is once it loses the hype, like it's hard to get the hype back. And fundamentally, those companies have done amazing. And I think, their earnings will speak for themselves over the coming years, but that overall hype is not really there right now. I think that's okay. Yeah, maybe if they split their stock. I mean, I've been wanting Meta to do this for a long time. Now, splitting your stock doesn't necessarily mean everyone's going to buy it, but it is a little easier for someone to buy 100 shares of a $90 stock versus a $935 stock. So same thing with Meta, $50 per share versus 570 is a big difference just in terms of the level of shares you can get being purchased. But given, you still have more shares outstanding, it doesn't really make that much of a difference. So we're going to see, but a lot of the memory stocks have not really done much over the past couple of weeks now. NVIDIA right there, that's up 0.12%. Gap had a good earnings. I don't know if this thing deserves to be up 18%, but I think the market kind of wanted something a bit safer than the tech names yesterday, and so that's why it's up. They raised guidance, beat on EPS, beat on revenue. I mean, it was good numbers. It wasn't like blow away crazy numbers, but you could argue that the stock was relatively cheap going into the print, so any good numbers would get it to move, and that's what we saw today. NVIDIA right there up now in the pre-market 228, as that is green. The information says the U.S. is developing AI regulations to limit China's access to chips. So this is consistent with the potential semiconductor tariffs that the U.S. was exploring that we talked about yesterday. Yeah, I mean, I don't think it's going to affect NVIDIA. I don't think NVIDIA is guiding that 70% because they're selling a decent chunk of chips to China. But if NVIDIA is going to keep growing at the level that they're going at, and the Chinese are going to keep innovating with open source models, then the US obviously is going to want to have some say in terms of how much capacity they have for technology, but it shouldn't affect the broader semiconductor ecosystem in the United States, given how much NVIDIA is growing. Zeta right there, that's down 1%, Coherent's down 1%, Nebius down 1.7%, Keel's down 1.4%, Robinhood's down 0.5%, SK Hynix as well is down 1.8%. SanDisk, are we green? SanDisk is red, down 1.5% as well. Andreessen Horowitz raised $1.1 billion for a hardware infrastructure fund. Okay, so one of the biggest VCs just raised $1 billion, likely to invest in more chip companies. Hardware infrastructure is most likely associated with AI semiconductors. So you've got even more private money entering these chip plays. There's that company we talked about called Etched a few weeks ago. They raised at a $22 billion private valuation. And their goal is to literally compete with NVIDIA. Like the founders are like, we want to be the next NVIDIA. And the fact that they even got a raise in the private markets of that much money just goes to show you how much growth really is in the broader industry and why NVIDIA is able to guide for 70%. I mean, if you got private companies that are building competitive chips, raising a $20 billion valuation, like it's not easy to be a private company, get a $20 billion market cap. It just means there's a lot of demand for these chips, which is why people are bullish for Iran, right? Because if there's so much demand, that compute needs to be serviced. That's why people are bullish for Marvell. You need the optics. That's why people are bullish for Micron. You need the memory. So that fundamental thesis has not changed. It's just the stocks have consolidated in a different way. So Jackson Hole, let me see. Kevin Warsh, I think it's supposed to be 12. Oh, no, they're saying 10 a.m. Oh, that's even better for us then. I thought it was going to be at 12 p.m. Oh, that's perfect. Okay, so 30 minutes after market open. Okay, that's great. So we don't have to wait till 12 then. So we will have Jackson Hole at 10 a.m. I'll do a poll right here. What do people think it's going to be? I kind of think it's going to be a nothing, but I would hope it's been a relatively good week for the market. I would like it to be a nothing burger. If it's one of those monumental that he has and the market starts feeling a whole different perception going into September, that would kind of suck. So honestly, if he could just get up there, say good morning and say nothing, that'd be nice. Okay, so Kevin Warsh, big deal, or let's do hawkish, dovish, or nothing burger. What do we think for Mr. Kevin Warsh? Do you think it's possible to see 800 on SanDisk? It's possible, but I find it unlikely. I mean, it bottomed at like 980, and that was at the absolute lows of the liquidation. That's kind of like Nebius at 140. Like a lot of those prices you saw on July 29th, they weren't real. They were kind of manufactured. So I wouldn't expect to see those unless, the broader market takes a really big hit. And then you look at NVIDIA's earnings and you'd be like, okay, why would the semis take that big of a hit again, given how much momentum in video showing. By the way, speaking of Citadel, they had a massive Q2 based on all these trading volumes. 1 of every 3 trades in the country happens through Citadel. They posted a record Q2 with trading revenue reaching $7.3 billion. That's up 300% year over year, and net income rising more than 250% year over year. They now handle more than 1/3 of U.S. retail stock trades. So the Leopold liquidation helped them get some more momentum. Okay, let's talk about Grand Theft Auto. So you guys know my take on this. I've been very skeptical of Take-Two and Grand Theft Auto, and like not bearish, but just like I don't know why the stock has been so exciting to people because I didn't get it. I watched some of these streamers react to Grand Theft Auto yesterday, and I'm starting to understand the hype and why people are so excited. Some of these videos have multiple millions of views for people that saw the trailer and then saw the people reacting to the trailer. And if you look at the comments to get a gauge of like how the broader public is thinking about the perception of this game, it's like 99% of the comments under all of these videos are excited. They're hyped. They feel like Rockstar took their time to really build something special. And they're very, very excited to buy the game and eventually start playing it. So I don't have a position in this name. Could it pump? Yeah. I mean, the EPS growth, I was looking at it last night. It's expected to go up a lot from this year. And then the year after that, it's expected to do, it's supposed to go from like $6.40 to $10 to then $10.18, something like that. So the 2 years out, it's expected to have a insignificant level of EPS growth. If the game is way more relevant than what people think it is, then that EPS growth is going to be way better in 2028 than what the street is expecting. And that's where you can see the stock and the multiple expand. So I think from a trading perspective, off the idea of the hype, you have a lot more evidence today based on the trailer and the reactions to the trailer that this game is going to be special. But ultimately, they need to prove that those sales end up being what they need to be. JP Morgan said, we project $4.5 billion in sales by launch week. And Morgan Stanley described themselves as bullish following the trailer launch based on the reaction to what they saw with the trailer. Feels like it's going to be a sell the news. It might be. I mean, I feel like it's one of those where you have to monitor the trade. It's not even that much about the numbers. It's more so about just like the sentiment of how hyped the game is. And then does the stock deserve a further premium? I mean, people are still playing GTA 5 to this day, right? 14 years later. So if this is a game that is going to be reoccurring revenue in terms of the virtual currency that people pay for inside of the game for years, then maybe that's going to be a lot more people excited. Put in the chat if you're actually going to play the game itself. How many people here are going to play the game? It feels like a trade, not an investment. Yeah, that's what it feels like as well. I mean, I don't know enough about Take-Two to want to hold on to the company for 5 years, but the next 5 months, there might be an opportunity, but I don't have a position in it. I'm just trying to better understand like why people are, me and Steve talked about it on Basis Points yesterday, like why people love this game so much. Because I played Grand Theft Auto before, but it was like 15 years ago, and like I never got hooked on it that aggressively. And he gave me some broader insight into why people love this game. Wow, decent amount of you. Yeah, I think the other thing is, look, from a content perspective, it is going to be on Twitch and YouTube, like definitely all throughout the end of the year if it comes out in November, and then probably for the next 7 to 8 months in 2027. Like it is going to be one of the biggest things that people watch from a streaming perspective, which is just going to create more attention for the game in and of itself. And if that's the case, like the question is, can that result in just more earnings growth for Take-Two if people start to buy it? Hollis says, I'll probably spend $1,000 on game purchases. It's kind of crazy. When I asked you guys, would you spend $200 for the game? And all of you guys were like, no, like the max you would spend is like $80. But then a bunch of you are ready to spend more than $200 on virtual currency in the game. And like, it's a weird psychological thing. It's like, you don't want to pay a lot for the game, but inside of the game, you want to pay for like all the different like things you can get in the gameplay itself, because that's what makes the game fun, right? And so I think that's where a lot of Take-Two is going to make their money, which is also really important for that earnings growth. Is Beth Hammock on Bloomberg right now? Oh my gosh, she's probably being super bearish. She's probably being super bearish. There she is. She's live. All right, let's go to her. Hopefully we get a Kevin Warsh that is not as hawkish as her.
First mortgage was 17%.
Exactly.
Right. And so I think you have to normalize. I think when we go back and look at the history, I think what we'll see is that period from 2008 to 2020 was the abnormal part, not the scary where we're at today.
A lot of debt got incurred in that time, though, and housing prices are a lot higher. The U.S. now has $40 trillion of debt. How much does that compromise this argument that this may be the normal, but it isn't sustainable for this, at least government, and certainly the spending there?
Well, I have one job, and that's to make sure that we're delivering on maximum employment and price stability. That's the only thing that I'm focused on when I'm walking in the room.
Do you care about the 30-year yield today?
I do look at the 30-year yield. I look at the 10-year yield. I look at the full shape of the interest rate curve because it does give me some sense of, again, where financial conditions are and how difficult or easy it is for businesses and households to borrow.
Do you think that the 30-year yield is rising because of fundamentals, or do you think it's rising in part because of this anxiety, this agita around the Fed's reaction function?
You have access to a bunch of amazing market commentators who can give you much better insights as to why it's rising than I can. But I look at a variety of factors that are driving it. And I think there's, a confluence of expectations of what our policy is going to be, expectation of how persistent inflation is going to be, supply and demand forces at play. All of those, I think, are come into play.
President Hammack, have you seen any bears yet?
No, but my kids did yesterday. They were in Yellowstone and they got me a great video of a bear kind of nosing around in the bushes.
Oh.
And I'm hoping not to see any more.
President Hammack, thank you so much. Cleveland Fed President Beth Hammack there. Really interesting to me how she is parsing.
Okay, so you had some more hawkishness from Hammack. She's the one who wrote that LinkedIn post the other day, basically saying that like business owners and her business owners and independent contractors, vendors, and distributors. She painted like these different scenarios of people that can't afford high prices because of inflation. And so the solution is we have to tackle it by raising rates. And it's tough because it's like if you raise rates, all those people are still also going to feel the pain. Inflation takes time to resolve, but the immediate short-term impact on people who are trying to buy a house or people who are trying to start a business is going to be the cost of capital goes up. So I really don't think the solution is raising rates, but if the Fed ends up doing it or Warsh ends up signaling that he has to do it, because at the end of the day, Warsh is just one vote on a committee of 12 people. If he has to give in to what the committee is saying, especially because, the bond market's kind of screaming right now and it hasn't really calmed down. At least it's not at 4.7 on the 10-year anymore, but you need this war to kind of come to an end for bond yields to get back to 4.3, 4.4. We're at 4.68 right now. So we're basically back to 4.7, which is not really what you want to see. Maybe they end up hiking. And if they do, then it is what it is. And we're just going to have to deal with it. It is kind of, if they do end up hiking, it's not going to affect NVIDIA in terms of like their growth. It'll probably affect NVIDIA stock. But I wonder if NVIDIA gives us an opportunity again below 200, just based on macro stuff, because once again, the growth guidance that we got is so unbelievable at the scale that they're operating at, that it's like if the market really did take it down and we had a little 5% crash on the S&P, would that be one of the best opportunities going into the midterms? And would it be consistent with every other midterm year where we bottom in October and then we kind of end out the rest of the year much stronger? It would be one of those things where it would be exciting to see that opportunity again, but it would also, I wonder, be scary for people, because if it can't pump off that much growth, what is going to take it to pump? But if it's more of a macro thing for why it's not pumping, then I think it's going to be a great opportunity, just like July was. And we just have to see if that ends up fully playing out. The majority of you in this poll, it will affect small caps. That's fair, as those are the most rate sensitive. It will also hurt neoclouds. I agree, as they have a lot of debt, so the cost of capital effects. And the majority of you in this poll around Kevin Warsh, let's pull this up, is 59% saying it's a nothing burger, 22% saying hawkish, 19% saying dovish. So we will find out at 10 a.m. when he speaks. Mike, and thanks for the super chat. The market is your GTA 6. Playing the market is like playing a video game to an extent, right? And there's so many different variables we have to deal with, including real money that's in that game. A couple other things from Hammack. Hammack said delaying rate increases would create problems. Hammack said she does not view financial conditions as restrictive. Hammack said inflation could finish the year at about 3%. Hammack said keeping the public informed about federal issues is part of the job. So you got some bearishness from Hammack. You had Stephen Moran on yesterday on CNBC, and he basically said that there's no need for us to hike. So, Warsh has some support on the Fed, but today at 10 a.m. we'll get a broader take around the holistic perspective of what's going on with the Fed. Broadcom, are we green on that? That actually got a little bit of a pump yesterday, 375. Yeah, this one did not deserve to go to 359. So it's nice to see that getting a little bit of a comeback right there. But it is at least somewhat green from the lows. Speaking of bears, as Hammock mentioned, you have 2 new Sailor AI videos in which he's actually rather violent when it comes to the bears. Trillions of dollars of capex, folks. Trillions of dollars of capex. Yes, PayPal is down because Stripe pulled out their bid. So that's why PayPal is down 14%, as Stripe is not bidding to acquire them anymore. But not only was he violent to the bears, he also got violent to our boy Tom Lee.
Bitcoin is the apex property of the human race. It is perfected money. Bitcoin is the best asset. There is no... There is no second best asset. Bitcoin.
I didn't expect to wake up and see that, but you know, Tom Lee ended up taking a bit of a beating right there. The caption was, "Sorry, Fundstrat, there is no second best." So, I mean, that's there's no way this is real. This is very real. It is Michael freaking Saylor who posted that. I will say, as cringe as these videos are, he's having fun with AI. Like, I have not had this much fun with AI like he's had. Like, I should be using AI in a much more fun way to make these like small little videos. I've not done it, but like these are like good videos. Like, it feels like it's real, and he's enjoying it and he's having fun with it. And it helps that Bitcoin's going up. You know, if Bitcoin was going down, I think people would hate these videos more, but at least you got a little bit of momentum right there. 79,374 on Mr. BTC. Zoe says I would watch a UFC match between the two. I think that would do some numbers. I think that would do some... Someone said I spit out my coffee. Yeah, I saw it in the morning. I was like, goodness, dude, this guy does not care. We just used a video that took a small town's worth of electricity. Yep. That's why we need more compute. That is why we need more compute. All Niner, thanks for the super chat. Is there news on Amazon, or has it just been lagging? I think the reason Amazon is down, believe it or not, is because they just committed to buy another 2 million GPUs from NVIDIA, which means they're going to be spending a lot more money. It's such a stupid reason because they already said they're going to spend another $220 billion on CapEx. They're not going to have free cash flow, but the market is the market. The fear I have I'm trying to come up with my fears for 2027. Obviously, we have a few months before we get into like 2027 previews, but one fear I have is that if the market, for whatever reason, takes down the Mag 7 stocks aggressively next year because of the fears of CapEx, which you can say the market's not going to do that, but the market literally did that for 7 months this year until last month, where it kind of switched its tone. And the only reason it switched its tone is because the semis got obliterated. So I think the algo's kind of switched back to the Mag 7. If we do have another sell-off of Amazon, Meta, Google in 2027, where the market just doesn't like all the money that they're spending on CapEx because maybe the growth rates just aren't good enough to justify it. This year, I think the earnings have been really good. But what if next year it's not, right? Like, what if that's out there? Do these hyperscalers pull back on some of their CapEx even just a little bit? And does that, explode their stock prices to the upside? And then if Amazon sees that, oh, we have a $315 stock because we're spending a little bit less on CapEx, maybe we're going to guide to spend a lot less more on CapEx. Now, the reason I don't think they would do that is because then they might not grow as much. Like the utopian scenario is Amazon grows 35% on AWS and they have to spend 30 to 40% less on CapEx. I don't think that makes sense because the only reason they're growing this much on AWS is because they have all the GPUs to support all these AI workloads. So when the market sells it off for CapEx, it doesn't make sense. But nonetheless, if all that free cash flow comes back and the market gets excited about it, Rocklab right there down about 1% as well, that might be an incentive for some of these companies to pull back on the spend. It's just they've given every indication they're not going to do that. So it's one of those things in 2027 we have to watch out for. But if Jensen's saying he has visibility into 70% growth, it also pushes back against that case because it's like, that growth is coming from the hypers. That's not Nebius and CoreWeave getting you hundreds of billions of dollars of revenue. That's Amazon, Microsoft, Google, and Meta. So it doesn't feel like the CapEx thing should be the biggest concern going into 2027. But we're going to have to see more broadly what the guidance looks like into Q3. And then we'll get some fiscal year guidances in Q4 as well. Mick, can you ask Trump to end the war? Please use your influence. I don't know if I have enough influence to ask Trump to end the war. I think if Stanley Druckenmiller writing an article is not enough to get Trump to realize he needs to get these yields to come down, which means you have to end the war, then, it's going to take some time. But hopefully we're going to see if that ends up happening eventually. Get Trump on basis points. That would be a fun conversation, but I don't know if we would get him to end the war. Oil is down today, at least a little bit, down about 1%. So you do have that as a backdrop. And I don't think anything's going to happen meaningfully until we get that war speech. We got to get that speech out of the way. And then we'll keep going from there. Can you talk about Vistra? So I wrote up a whole thread on Vistra on X. I'll link it right here. People can read it. At its core, the stock is too cheap if you think energy continues to be the bottleneck. The valuation right here at 138, it's like 140 now, trades at 8 times 2027 EV to EBITDA, 9 times 2026, and then 10 times 2026 free cash flow. CEG trades at 22 times forward earnings. Vistra trades at 13 and 14 to 15x EV to EBITDA. That's almost a doubling of Vistra's multiple. So I really like setups like this, or I'm starting to enjoy finding names that have this type of setup. And I think, the other setup that reminds me of Vistra, a totally different sector, Zeta. If you looked at Zeta's multiples compared to every other advertising name, it looked like Vistra. Every other advertising name was like 3 to 4x greater on the EV to EBITDA versus Zeta. But Zeta had better revenue growth, or at least comparable revenue growth. And if you look at CEG's debt, because people say, well, what about Vistra's debt? Well, CEG also has $20 billion in debt. So does Vistra. Now, I don't think Vistra needs a CEG multiple, but they have a 20-year deal with AWS, 20-year agreement with Meta. They already have a big partnership with NVIDIA, KKR, and Kia. They have 3.8 gigawatts tied to AWS and Meta alone. I would imagine the reason Tepper's buying, the reason Teal is buying is because energy they are seeing as the obvious bottleneck. This is not the most exciting company in the world. It's not like the next Bloom Energy or anything super kind of pumped up with excitement around new innovative forms of technology, but it is nonetheless a name that should benefit from the broader adoption of building out these data centers in the context of having more energy. So to me, it's just a multiple re-rating question. If you look at what I think could be a base case is $185, give it a 9x EBITDA multiple. They're already buying back a crap ton of stock. Every $1 billion of buyback roughly retires about 2% of the share count, and they've already bought back $6.5 billion of stock over the past 5 years. They have another $1.2 billion that they have to buy back. If you give it a bull multiple at 11 times EBITDA, you get to $240 a share. The bear case is at 110. I don't think we get there with 7x EBITDA, given it's only trading at 12 times EBITDA right now. So you can read that thread, but in general, I think it's a pretty simple. I'm trying to see why are the big guys buying it, because that's what got me first interested. And then I looked at the chart, look at the consolidation. I'm like, okay, there are risks here, but if energy is the bottleneck, there are names that are cheaper. Talon is another one. It's not as cheap as Vistra. This is the one Jason likes. But Talon, CEG, Vistra, they're all down 20% this year, right? So the market has given a lot of the momentum to the semiconductor names, the picks and shovels, the optics, the memory. It's kind of left the energy names for dead. The Bloom energy names, the ones that have been more innovative, have gotten a lot of love. But the sort of traditional energy names outside of like Chevron and Exxon, because those are pumped because of oil prices, have not done much. And so I think that's where you might have a deeper opportunity. Again, PayPal's down because Stripe pulled out. So PayPal down 14% right there. Let's see if that actually goes down further. PayPal, I always thought Berkshire would buy. I really always thought Berkshire would take a stake in it. They haven't done it. Maybe this is the opportunity for them to do it as well. GEV also has higher growth. That's true, but GEV also is up a lot more this year, right? GEV year to date is up 40%. So, and over the past year, it's up 50. GEV has exploded. And, the demand for turbines has exploded as well, but I don't know if it's the best opportunity, just given the stock is up so much this year. Rubrik, again, good earnings. I think it was probably priced in. Stock's down about 5%. Marvell, also great earnings. And that is down 7%. Meta also has not been able to really catch the bid even after the settlement, kind of stuck at 570, but at least it's out of that 540, 550 range. And you've got this new Hatch product coming from Meta, which will be their consumer attempt to have agentic workflows for everybody. And maybe that could be the next catalyst outside of the lawsuit coming to an end as well. All right, we have 2 minutes until the market opens. Thank you all for being here. Is everyone tired? Is everyone feeling tired on this Friday? I woke up just feeling tired, bro. Like, this was one of those Fridays where I woke up and it's like, man, I am tired. I think it's been a long week for all of us. It's been a long month for all of us as it's coming to an end. But got to end out the week correctly. Hopefully in 30 minutes we get Warsh and we get some good commentary. Is anyone taking a day off from work today? Like a call-in sick on Friday type of thing? Or for the people working from home, is every day basically effectively calling in sick to some extent? Wired on 3 cups of coffee. Yeah, there was a full moon last night as well. I'm tired of looking at Marvell stock price. Rick, you can't be too upset about it, man. It's up 170%. I know at 3:30 it was euphoric, but that was also kind of Jensen more than the market. Every Friday I take off. So says I'm off Friday, Saturday, Sunday. That's great, being off Friday, Saturday, Sunday. The weekend starts early. I thought about calling in sick today. Yeah, I feel like everyone's tired, right? Everyone's tired today. I just woke up and I'm like, man, it's been a long week. Long freaking week. Amazon right there. That's up 1%, getting a little bit of a bid. As we get into it, about 40 seconds, there will be a bell that is rung in a little bit. So for everybody watching across the entire planet Earth, wherever you are watching from, I am deeply, deeply grateful that you choose to watch, that we see if these stocks can continue to have strength in this market, because we want to see a ton of strength in this market. Those that don't get why I'm saying it, it's like, why does he keep saying the word strength? But we want to see strength in this market without the G. And we want to make sure that we can continue getting this momentum. And if you're awake on this Friday across the entire world, you know that it makes no sense to mute the bell. Ladies and gentlemen, refute the mute. It is August 28th, 9:30 a.m. Thank you for being here. The stock market is now open. All right, wake your asses up. Let's get into it. NVIDIA opens red. Look at that candle down. They took her down right from 228 to 227. NVIDIA opens red. Broadcom opens green. SanDisk opens red. Micron opens red. IREN opens red, down 7%. Marvell is red, down 7.5%. Rubrik actually, okay, that makes sense for Rubrik. Rubrik's earnings were not something that deserved a 5% down day. So that one actually flips green from down 5%. That's nice to see. Rocket Lab 6628, that's down 2%. Grabs down 0.5%. Open Door down 1/3%. Workday up 1.2%. They had a really good earnings as well. So Workday was great. Robinhood has had a good week. It's probably not breaking out to that 120 because Bitcoin is still kind of stuck, but 109.85, not too bad on Robinhood. Was stuck at 90 for the majority, 95-ish for the majority of July. Palantir gets up to 187. Let's see if we can, I mean, maybe 190 is on deck. I think psychologically it might be a little hard, but if the volume's there, we're back into the mid 180s. PayPal down 14% on Stripe pulling out. Take-Two based on that GTA trailer. Wow. Loses the entirety of the pump, 242 to 234. So you had plenty of sellers come in even after the Grand Theft Auto trailer went live. SpaceX 139.68, that's down 0.5%. Broadcom 372. SanDisk still down 2.7. IREN is down 8%. As that continues to take a hit, HIMS is down 1%, ASTS is down 1%, Cisco is down 0.5%. ETH is up a little bit at 2,500. You know, last time ETH was at 2,500, Bitcoin was at 80. So the fact that Bitcoin's actually down and ETH is up is kind of nice to see some divergence right there. But 2,500 on Mr. ETH. How about SoFi? Are we green? We are green. I think we closed at 19 yesterday. So if we could hold on to like 1950, if not get a little bit closer to 20, that would be very nice to see. Shopify is up 0.31%. Zeta, second day in a row of that beautiful 3 handle. I mean, that's just so nice to see. It's really nice to see a name that was undervalued, put up the earnings growth, and then get properly valued. And now, a dip to like 27 is a real dip, 26 is a real dip versus having to fear that it's going to go back to 19. So you're seeing a re-rating happen in front of us. And as long as the company keeps executing, we can hopefully hold on to this 30 level. Meta right there, 577. That goes green to open today's service. Now 180 or 80 to 140. I mean, massive, massive move on a lot of these software names. Salesforce, CrowdStrike. Salesforce up another 2%, 255. Salesforce was at 150. I mean, SaaS just made, SaaS made a comeback in different ways. Palantir was the first name to come. Then it was Shopify. Then it was Reddit. Then Zeta over the past 2 weeks. Now it's Salesforce and ServiceNow. Like, it had different sections of names that would be coming back. Adobe's back, but all of them. I mean, Adobe's about to hit 300. Like, can you imagine? Adobe hasn't been 300 in a long time. It was at 190 at one point after a bad earnings in April. Like, this thing getting back up to 300 would be incredible to see that momentum coming in. Intel's down 2%. AMD is down 1.2%. Apple, interestingly enough, is going up. I mean, it makes sense that Apple's going up because your semi names are red, which means your high beta growth is red. But the fact that NVIDIA's closing in on, not really all-time highs, but actually NVIDIA's all-time high is like around 230, right? 236, yeah. So it's a little far away. But usually when NVIDIA gaps up like this, Apple doesn't. So the fact that Apple's actually going green is nice to see both moving together. But it also means the other high beta names are taking a bit of a breather. Marvell, this was down 7% when we opened. It is now down 8%. Nebius is down 3%. CoreWeave is down 1%. So your neoclouds have not had the best week. Your memory names have not had the best week. AppLovin, this is the other software name that hasn't really made a move. 300 to 321. So at least you're seeing some excitement there over the past couple of days. 321.40. It is down from that 450 level from a month ago. Tesla's up almost 1%. MicroStrategy should be green, right? That is, well, slightly. No, Bitcoin's actually down. So MicroStrategy should be down about 1.9%. Microsoft, very nice. See the software come back in continuation. So software continues to be rolling, which is why your Microsofts of the world highs holding an IGV that's up at 508.64. Shopify 155, Salesforce at 257. Crowd actually goes red. It had a really big day yesterday, so I can understand why it's taking a little bit of a breather. And then Intel 94 to 90. Admit I bought a ton of Nike. Wish me luck. Nike is 38.72. I think Nike you can play between 38 and 42 and trade it. If you're buying it for a breakout into the 50s, I think it's just going to take a little bit of time and execution from management to show their brand positioning continues to be strong and get this company back to growth. Effectively, the question is, has Nike bottomed, and are you willing to hold it for the next 5 years? And I think willing to hold it for the next 5 years, it'll be greater than it is today. Has it bottomed? That's the question where it's like, I don't know. There's two reasons. One, the PE is still relatively high compared to other companies. So that could have some multiple contraction. And then B is like, what if the consumer actually legit slows down next year? Oh, by the way, I think today we're getting job revision data, which will be important for all the consumer companies. But if the consumer is going to be stable for the next couple of years and Nike's bottom, then obviously I think it could, get back into the like 45, 50 range, which would still be down substantially from where it was. So like taking a shot here might not be the worst thing in the world. But we should be getting today the revisions on jobs at 10 a.m. Wow, right when Warsh speaks. So last year we lost 911,000 jobs, which means we basically all the job growth that they said we had in 2025 was taken away because we didn't actually have it. T1 Energy, that's up 1%. So at 10 a.m., we're going to get that data. We also get consumer confidence at 10 a.m. And then we get Warsh's speech. And then we get consumer expectations with the Michigan survey. So you're going to have a decent chunk of macro data. ServiceNow, 141. Boom. Congratulations. I have a very small position in ServiceNow that I bought at 105. Nothing too crazy, but congrats to everyone who went super heavy in this. Congrats to our boy Chris Patel. I mean, he was preaching this pretty heavy. Recently just bought a house. I think ServiceNow is going to make the purchase of that house a lot easier for him. But there you go. 2%, 140, 130, 80 to 140. Really, really nice to see high quality companies getting this. I mean, Bill McDermott bought shares at 103, told you he was going to keep buying shares, and then said, I don't think the company is in a space where it will be commoditized by AI. So the same thing with Nikesh, who bought his stock at 200, bought 10 million worth of it. A lot of these CEOs are just like, this is stupid. This is actually stupid. And they told you how stupid it was. And then it was just a question of, did you believe them? And whether it was Benioff bought 25 billion of his stock, right? He literally went into debt to take money to buy back the stock. So whether it was Benioff or McDermott or the Zeta CEO or Karp or Toby from Shopify, all of these names just had different opportunities that they presented themselves with. Zeta trying to go for 31. Let's see if we can get there. Maybe there's a shout out to Andy in the chat. I know he's been buying ServiceNow and Salesforce aggressively, as he has let me know it is service currently right now. Those call options currently right now should be a lot more greeny green than they were a month ago. Netflix, that's up. Trade Desk, that's up a little bit. Uber, this has been stuck between 77 and 80 all week, but that's at 77. Okay, so Affirm, they increased their gross margins by 330 basis points. I think that was the reason why it pumped. They announced some deal with Shopify in Australia, but the reason it's up 15% is because of a massive margin increase that they talked about on the call, not on the actual earnings numbers, which is why during the call, the stock flipped up. But it's good to see some fintechs getting some love, right? Like for so many months, it was every sector is dead besides semis. And I think that is flipped. And it's very healthy that that flipped, because the semis are still up a lot this year. They're consolidating, and everyone else is starting to get some of the market momentum in this bull market, even crypto, that has been missing for the majority of the year. Do you think Zeta could get to 40 by end of year? Look, fundamentally, I still think it's cheap. But we would need a bull market towards the end. Like we would need the Fed to be on our side. We would need the war to be over. Like now, if you're talking about Zeta at 40, Palantir at 210, ServiceNow pushing 170, like you need a real bull market to get some of those multiples to come back. It's not as easy as like mean reversion or just like having a basic normal free cash flow multiple. AMD 474. But this Warsh speech today is going to be important to see if we can get there. SpaceX 141, that flips green. Hopefully that can help Rocket Lab, which every day has just been going down 1%. It's kind of crazy. But maybe SpaceX breaking out could help the lab of rockets here. Micron also trying to flip green, 926. NVIDIA 227.54. I think all those are gapping up right now because NVIDIA potentially is putting in a little bit of a short-term bottom at 226.05. Let's see if NVIDIA can get back up to 228. Rubrik's still red. Yeah, 1% daily. It's been ugly for a lot of them. But the entire space sector, has been taking that hit. Redwire, Lunar, etc. So says, when ServiceNow was in the 80s, my company bought into their services. The company I work for is no joke with spend. It was a no-brainer for me to buy ServiceNow. Yeah, see, a lot of the qualitative stuff and anecdotal stuff is really important when trying to assess conviction. And I think that's why people go to X, right? To like really get different perspectives and hear from different people. I mean, that's what Chris was saying. They use ServiceNow every single day in his hospital. So sometimes that breaks the mold of the narrative that these companies can be vibe coded away. And it's good. I mean, like AI should be a tailwind for software companies, not something that replaces them. The crappiest software companies will be replaced, but like Salesforce, ServiceNow, like these are companies with hundreds of thousands of users. Like these are not things that you just replace overnight. So it makes sense that the multiple is coming back. Same thing with Adobe. Microsoft right there, 509. Same thing with Microsoft and the software that they sell. NVIDIA, 228.70. As that officially goes green for NVIDIA. The Q's getting a nice little pump as well. That's up a little. Can you talk about Rubrik? They had a really good earnings. We looked at the numbers last night. I don't know the most about this company. The only reason I can say it's down 7% is because it's up from $40, got to 110. So in my head, I'm like, okay, maybe a lot of this move was priced in, and I don't know what the market is upset about when it comes to Rubrik. I mean, if you can nitpick, you could say their subscription ARR is declining in growth year over year, but it's still growing at 32%. So yeah, it's not at 37% anymore, but that doesn't mean it's not growing. But like even then, that's not a reason for Rubrik to be, especially given it's in the security space, and we know how much that sector is getting love. That's not a reason for it to be down. So I would just say the stock pumped way too. Same thing with Marvell. There's nothing really to say about the earnings that's bad. It's just it pumped so much going into the print, 206 to 250, that if the numbers weren't just massive blow away beats, which they weren't, they were good, but they weren't massive, then I think it's just taking a breather from that perspective. But overall growth seems to be very strong in a lot of these different software names and semiconductor names. NVIDIA, let's see if we can hit 230, man. I wasn't live yesterday when we hit 230. We touched it for a little bit. It would be nice to see 230 together. 228.42 on NVIDIA. Palantir, we got at 187, back to 186. Warsh is in 20 minutes. He should be. Whoa, someone just bought... Interesting. Someone just bought some calls, $12 million expiring 10/21 with a strike that is 100% out of the money on the VIX. $28 strikes, 10/21, 12 million in premium. VIX is at 14. See, that's a little scary because if someone is betting on the VIX to double by October, when historically in the midterm year, that's when the volatility peaks and that's when we bottom. Now, that could just be a hedge against someone who has a massive long position and they're like, hey, I need some protection, and the VIX calls going into October with a $28 strike. I mean, that's a hell of a hedge if you think it's going to double. Like, I would 19.20 would be more appropriate in terms of the premium. But that, see, it doesn't feel like a hedge. It feels like someone's betting that we're going to get a volatile event in October. But maybe it is a hedge. And that is part of the reason why the VIX has been so low this year, because we haven't really seen that type of volatility. So if people are expecting that, even as a hedge, they may be wanting to get some exposure to it. Microsoft 511, which is nice to see. It's for the midterms. Yeah, but, you know, I think there's a question this year of like, hey, every midterm year we have volatility and stocks really take a hit. We've already taken a hit 2 times this year aggressively. Do we once again have that same midterm volatility, or do we avoid that? Because in previous midterm years, we didn't have a war in March and then a deleveraging event to the tune of hundreds of billions of dollars in July. So like, do those two things make this year different going into the midterms? The person who bought these calls probably thinks not, but if it does, then maybe we don't have to necessarily deal with that. SPY 772, as that continues to be green. How much were the calls? 12 million. It's not a million, it's 12 million of those calls. ServiceNow 1 point. Honestly, it might not be a horrible hedge. I don't think people have to do $28 calls, but even if you buy $20 calls, like if things really get a little ugly, those should print nicely and at least offset some of the losses on the long side. Archer, we haven't looked at that in a little bit. Archer is down 2%. The eVTOLs have not had the best year. They had a little bit of room to run 2 weeks ago when they announced their earnings and some partnerships, but we haven't really seen much since then in a meaningful move after those earnings. Palantir trying to go back from 187. Marvell still down about 7%. Did you see CXMT earnings? Yeah, so CXMT is the biggest Chinese company for memory, which trades at a multiple that makes Micron. I mean, if Micron had its multiple, it'd be like a $3,000 stock. So the street in China definitely respects this company a lot. So this was their growth: $22 billion in revenue, 870% year over year. Adjusted net income, $11 billion versus a $300 million loss of last year. The profit guidance was $8.4 billion, which came in 36% above the high end. Q1 net profit was $4.91 billion. Operating cash flow, $19.5 billion. So they crushed it. There's a reason Apple's trying to buy memory from these guys, because they don't want to pay the prices that they're paying to the Microns of the world. But it goes to show that the memory names in the US will also have amazing numbers. It's just how much respect will they end up getting? I ran down 7% in that 37 range. Micron trying to recover and go green. Can you explain what VIX calls are? So VIX is the volatility index. It's just something that measures volatility. Usually when the VIX goes up, stocks go down because the market is more afraid of volatile events happening, or a volatile event is happening. In April of last year, the VIX was at 60 because of the tariff stuff, which had the S&P down 30%. But usually when the VIX pops up like that aggressively, it tends to be a buying opportunity because you're not going to be in that type of crazy volatile moment forever. And so when it pops up like that, you tend to buy stocks as they are taking a really ugly hit. And then as the VIX comes down, stocks can recover. Now, someone who is buying calls on the VIX 100% out of the money, VIX is 14, they're buying $20 strikes, is assuming that we will have a very volatile event going into October. And whether they're hedging their position or they want to profit off that, they know that stocks will go down and their calls will go up based on whatever external macro event could be happening at the time. Adobe right there, that's up 1%. Shopify, that's up 0.5% as well. As Meta going green. Meta back to 580. Chicago PMI comes in at 47.1. Wow. Expectation was 57.9. Okay, that's bad, but that's technically good because that's less inflationary. That's a little lower than what the market thought we would get right there.
Piece of last year to find a lower number, and we only had one read previous to this that was in contraction territory, and that was April, and it was only a bit under 50. So this is one of the few recent releases that gives us a more depressing picture on the manufacturing side. Much of the recent evidence has been significant improvement. Very quickly, here's the lay of the land. Right now, as we sit at 423, a 2-year, unchanged on the day, unchanged on the week, 12 basis points below its high yield close of 435. We'll look at a 10-year. Right now, it's at 467, down a basis point on the day, down 7 on the week, and it is basically down right around 7 basis points from its high yield close, which was not that long ago, the last day of July. JGB 10-year, 2 basis points away from a fresh 30-year high yield, and the Bund in Germany, which represents the EU, 327 now. That's it.
So you're seeing a bit of some red candles coming in. Market doesn't love this news. Manufacturing, for that to miss by basically 10 points right here, 47 versus expectations of 57, is a bit aggressive, but maybe it helps on the inflation angle. NVIDIA not loving that at all, 226.30, as that's taking a hit. Rocket Lab, goodness, dude, if they really take it below 60, it would be incredible. But 65.93, down 2%. Amazon's up 1, Broadcom's up a little bit. Wow. They're taking NVIDIA down, lost 226 within seconds, back to 225 here. See if it can hold out in that range. Apple at 315, that one also went red. All right, so SoFi also lost pretty much everything. So this Warsh speech is going to be the interesting thing now. I mean, I want to say he's not going to be hawkish, but he is only one person. And if these Fed presidents, if he knows they are going to make him hike, if he gives you that signal that, yeah, you know, we're going to have to hike, which I just don't think he wants to do that. Man, this one, I have no idea. My gut tells me he's going to be hawkishly dovish, aka he's not going to be explicitly hawkish, but he's also not going to give you what you need in terms of the idea of getting a cut. But if the terminal feedback of his speech is like, hey, we're not going to hike and we're not going to cut, I think we're okay. We'll probably go red on the day, but I think we're going to be okay. If the sort of central takeaway is that a hike is more likely than not, I think it's probably going to be a little bloody. But the good thing is the market will be able to bake in the hike. Like if he's going to tell us effectively he's going to hike, the market's going to be like, all right, cool. We got to live with a hike. 25 basis points, not really going to affect the broader economy. It's going to be annoying, but maybe we could bake it in and stop being so scared about it, which is important. Are you going to show it live? Yes. Should be live in like 10 minutes. Maybe it's a little bit late, but at 10 a.m. we should get it. SoFi 19. Salesforce still holding on to its move. Meta got to 584, and that PMI data got down to 579, but at least it's still somewhat green today. Oh, yeah, I wonder what crypto is going to do too, because if he says we're going to hike, that's bad for Bitcoin. But if he doesn't say we're going to cut, that could be also bad. If he says inflation is a big concern, if Bitcoin wants to be counter to inflation like it has been over the past couple of weeks with bond yields going up, maybe that's good for Bitcoin. So that's going to be interesting to see how the market reacts to BTC as well. So many different variables in playing this game. So many, I was actually at dinner with someone yesterday and they were like, do you pay attention to sports? And I'm like, to be honest, like outside of the Knicks and, some NBA here and there, no. but like the market is a sport because you've got all these different storylines, all these different things that are happening back and forth when it comes to how the game is being played. Pounds, you're back to 187. There you go. Let's see if we can crack 188. Service now 142. Wow, software continuing its second day in a row of momentum. Vivek, thanks for the super chat. Why is CoreWeave green when Nebius, Iran, and Applied Digital are red? I think we have to remember the NeoClouds. First of all, CoreWeave is up 10 cents, right? So like they don't move exactly proportionally with each other, but they are in the same bucket. So CoreWeave is green by a couple cents, which is better than being down 3% like Nebius. But nonetheless, Nebius has also outperformed CoreWeave all year. Iran is down 6% because the earnings yesterday weren't the best. So there are minute differences between these guys in terms of their stock price action. Obviously, there's bigger differences in terms of their companies, but I wouldn't read too much into like one of these names being slightly green while the others are red. Now, if CoreWeave was up like 5%, that'd be a different question, but you're not seeing a massive difference in how it's playing out. PayPal still down as Stripe has pulled out of it for the offer. Nvidia still getting hit. Wow, 225. Okay, so it took it down about 1.3%. Is gold up today with silver? Gold is flat. Silver is actually back above 70, up 2%. Fear and greed, that's a good question. Let's take a look at that. Who do you think the frontier model is that Iran is partnered with? If I had to guess, I would say Anthropic. But because there's only two companies that are frontier to me. It's Anthropic and OpenAI. Like, who else is frontier? Unless you talk about the Chinese labs, which I don't think they're working with. Fear and greed's almost at neutral, but we are at 56. Some people are saying Perplexity, but like Perplexity is not a frontier lab. Unless we're using the word frontier to describe companies like Perplexity. I thought it was, really OpenAI and Anthropic. I mean, Grok, you could say, is frontier, but I don't think Grok needs Iran's compute. So I don't know. But I think the fact that we don't have that answer is something people are a bit upset. Super Safe Intelligence, it actually might be them too. I mean, I still don't know what these guys do, but they are perceived as a separate lab that's frontier. Yeah, but I don't think Google's, Gemini's frontier, I guess, but I don't think Google is working with, Google already has deals with Cypher and Wolf. I mean, Google has a lot of access to compute. Like, we're talking about companies that are super compute constrained that need what Iran is offering. And the Amazons and Googles, I think, already have so many partnerships in place. By the way, if it was a Google, I think they would announce it. They announced the Microsoft one in September last year, right? Nebius and CoreWeave announced the deals they had with Meta and Microsoft earlier this year. So if it's a hyperscaler, I think you easily announce that. And you want to announce that because that would get the stock to be a bit more excited. So I kind of doubt it's a hyperscaler. Affirm right there, still up 10%. SpaceX at 141. They already disclosed Prometheus, though. It can't be Prometheus. That was already on their slide deck. So they did say it's a new frontier lab. I didn't know they're working with Figure. Apparently they're working with Figure, the robotics company. So they do have a bunch of clients already, but that major deal is, I think, what the street's looking for. Did Nvidia lose 225? Wow. What a fake out. They took it to 229.20 and now below 225. Goodness gracious. It's one of those Fridays. I think the market's tired as well this week. The market is tired as well. All right, so we are going to get a ton of data at 10 a.m. I think Warsh will not be 10 a.m. on the dot. I think he'll be at like 10:05-ish. So we should get access to the data before Warsh speaks. The data we're looking for is the job revision, which, what is the expectation on that? Last year was 911,000. There's no expectation. I don't see any consensus estimates. So I'm not sure what to judge it on. Then we have consumer sentiment. We need around 51 on that. And then inflation expectations, 3.3. Consumer expectations, we got to beat around 50. Current conditions, we got to be 51. So we're going to get that. We're going to get that data, and then we should get Warsh. AppLovin getting a nice little move today. What headline's messing with NVIDIA? I don't think it's a headline. I think it's Warsh. It's the biggest company in the world. It's going to be affected by whatever Warsh says. They did add almost $500 billion in market cap yesterday, so it was a good day for NVIDIA. At least it didn't go down the day after earnings, right? The earnings were so good that the market was like, we can't take this down. But they also didn't take us to all-time highs. So the fact that it's kind of stable after earnings, at least, I think is a good thing to see. AppLovin up 5% right here. Meta at 581. SPY. AppLovin's probably benefiting off the software isn't dead sentiment, even though there are some structural concerns with AppLovin. But if software is not dead, I think you just have a ton of money going into the sector. And AppLovin's one of the names that probably a lot of portfolio managers are looking at as like something that could give them more alpha going into the end of the year. SanDisk is about to flip green. It did flip green right there, 14.58. As that is not red anymore. Micron also trying to flip slightly green. Okay, let's see what else we have. We got about 2 minutes until we get into this. Meta is trying, Meta is using hardware from 3 separate robotics companies to push robots to work in their data centers, to plug cables, reset servers, and perform maintenance tasks as it expands AI infrastructure. Meta said they are investing in a data center worker hiring factory and training amid a shortage of skilled labor. You know, that's actually the super bull case for the humanoid robotics companies. It's not even replacing humans. It's that there are not enough humans that are willing to do this type of work. And so the robots ultimately become what could take that role. But even companies like Meta need different forms of robotics in their data centers. And I would imagine across the entire world, the business use case for them is massive. It's just the technology is not there yet, which is why I think there's a bit more hype on the robots right now. BMNR, that's flat on the day. IBM, that's down 1%. Where's our 10-year? That's also something we got to pay attention to while Warsh is speaking. We're at 4.6. Warsh should be in a couple minutes. I mean, let's see if he actually goes live at 10 a.m. I don't think he will. Usually there's a little delay, but let me pull this up and see. Intel is moving with memory. That's right. Do you own Oracle? Yes. I bought Oracle at 135 back in April. I've never really added to the position. It's kind of just been stuck. You know, ironically, I was looking at some of Oracle's numbers yesterday. $400 billion of Oracle's backlog. Like, I already knew this stat, but seeing it again yesterday just reminded me why I think the stock has been stuck, is OpenAI. Oracle's expecting OpenAI to pay them $400 billion. It's one of those things where it's like, all right, what if Sam doesn't have the money for that, you know? And like, what if the stock, the legacy software, but NetSuite, that stuff's not growing. It's all data centers. So if they don't get that $400 billion, or, you know, even half of it, it's going to be one of those things where I think the market's got to figure out how do we judge this. Oh, he's live. Okay, here we go. Kevin Warsh, he is live.
It was 25 years ago that we were colleagues. It's an honor to share the stage with you. It's great to be back here in the Valley again. See so many familiar faces from academia, from my last tour of service, and from my first 100 days, which is just this weekend. I've been looking forward to this weekend. And before I go further, I want to thank Jeff Schmidt and his team for the incredible hospitality. Everybody here is in debt to you and to your colleagues here at the Federal Reserve Bank of Kansas City. Jeff, our thanks to you and your team. Now, he and the other planners here have some recreation options lined up for later today. I'd advise you to be very careful with your choices. As I learned years ago, you can take 2 different kinds of hikes on the trails around Jackson. I can sum up my hikes with former Vice Chairman Don Cohn with 2 words: I survived. These steely marathon death marches revealed a sign of Don that I was not ready for. But there's another kind of hike. This one was with former Chairman Ben Bernanke, another dear old colleague. With Ben, it was a much more leisurely pace, an easy stroll along the wandering trails of the Rockefeller Preserve. So before setting out today, my recommendation is do a wellness check. Ask yourself, is this a Cohn day or a Bernanke day? The best thing about this gathering is that it helps us all get out here to the mountains and clear our minds and think straight about our world and our time. For me, it feels like the right place and the right audience for a real engagement with the ideas that matter most. Innovation, as Kristen mentioned, is the conference theme. And I believe the public and the markets understand that innovations in the conduct of Fed policy will help deliver price stability alongside full employment. So here's a quick overview of what I'll cover in my remarks this morning. You can call it an outline, you can call it a trail map, but please just don't call it forward guidance. First, I'll touch on a few of the longer term questions we're asking at the Fed about the latest general purpose technology, AI, and where it might take the economy. Then I'll reflect a bit on the practice of forward guidance and the interaction between the central bank and financial markets. Next, I'll present some of the key principles that I believe should guide the conduct of monetary policy. And finally, I'll give you my assessment of what's happening in the economy. So first, I think we should try to prepare a bit for future policy conjunctures. With the unchanging picture of the Tetons as our backdrop, we are here to survey an economic landscape that is anything but static. It wasn't so long ago, including in rooms like this, in the run-up to the crisis of 2008 and over the decade that followed, when economists and policymakers were speaking of secular stagnation, speaking of a global savings glut. It was a widely held view that an excess of capital would sit on the sidelines for a very long time because there just wouldn't be enough compelling investment opportunities. All the good stuff, you'll recall, had been invented, so growth would be low and slow. Well, times sure have changed. We've come to a hinge point in history, to borrow a phrase, a framing from my former mentor, George Shultz. To cite the clearest example, progress in AI, the 80-year-old name for the newest technology, has been faster even than its evangelists predicted just a couple of years ago. The potential for substantially higher growth is on the rise. Ever-expanding pools of capital pouring into AI-related infrastructure of all sorts. A kind of super Moore's law seems to be playing out. Scaling laws, too, are changing both the method and speed of innovation. Capital and labor have combined to create large language models at the heart of AI. Users buy tokens to gain access to these models. Reports put annualized token sales for the two leading labs alone at more than $100 billion, an increase of 500% from just 12 months ago. We at the Fed, we watch all this attentively. We recognize that AI is a new variable, potentially a new factor of production that will have consequences both for the economy and for the conduct of monetary policy. It opens up some major lines of inquiry. Will the application of AI cause a significant sustained rise in productivity across the economy? If so, when? Will token usage be complementary or competitive to labor? Will the next generation of AI models demand even greater capital intensity too? Or will the models themselves help devise a capital-light solution? Among the other yet unknowns is the resulting market structure. Who gets to make the money? It's not obvious where the returns on capital will land or on what timescale. Early on, how much of the surplus goes to owners of scarce assets, the AI labs or chip makers or energy producers or cloud providers? Over time, how much of that value accrues to businesses and consumers? And importantly, what are the implications for workers and for the employment side of the Fed's mandate? Likewise, we don't yet know the equilibrium price of the tokens that give access to these models. Might there be a heterogeneity of tokens such that growing sums will be paid for the access to the best models, those at the frontier? Will token prices for older models fall to the level of their marginal cost? Well, we'll be thinking through these matters with the help of a task force on productivity and jobs. My early check-ins with the leaders of that task force and the rest have been very encouraging. To be clear, though, their recommendations will come later and have no bearing on decisions we make in the current policy conjuncture. But I believe that for future policy challenges, this intellectual investment today will leave us much better prepared for tomorrow. Next, let me say a word about forward guidance and its substitutes. As our task forces go about their work, as you might know, I'm not waiting to introduce innovations at the Fed to help make us fit for purpose. To highlight one example, I've set out to change the form and function of the Fed chairman's so-called forward guidance. You might know about my longtime discomfort with early pronouncements of future policy decisions. I much prefer another path, and now we'll make the case for it. Transparency in communications about future policy decisions is not an end unto itself. Communications must be in service to the Fed's paramount responsibility. And what is that? That's getting policy right. Forward guidance as a regular practice was adopted by my colleagues and me during the global financial crisis. It was essential at the time, and we introduced it with much fanfare. But as with other legacies of crises past, I believe the practice has outstayed its welcome. In normal times, the role of forward guidance should be limited and circumscribed. Otherwise, it risks creating ambiguity in the name of clarity. Oversharing policy deliberations and overcommitting to future decisions can lead markets, businesses, and households astray. And I believe when policymakers make quasi-commitments on interest rates throughout the cycle, we inhibit our own freedom to make the right calls when it's time to decide. To get policy right, we also need to get the relationship right between the central bank and financial markets. The Fed needs clear market signals, as unfiltered as possible, from market internals, from the level and change in asset prices across sectors, the prices and trading volumes of Treasury securities, the foreign exchange value of the dollar, the cost and availability of credit, a broad set of commodity prices. These and other indicators should inform the Fed's near-term outlook on economic activity and inflation throughout the business cycle. They should also reveal the state of broader financial conditions and the risks and uncertainties of the financial cycle. At the same time, market participants themselves should be tracking real information about the real economy. They should draw their own conclusions, form their own expectations on things like output and employment and inflation, and they too should stay sharply attuned to risks. In my view, the Fed should be humble and never naive. The Fed plays an essential role in the economy and markets. Our tools are powerful. We determine the path of short-term interest rates, and market participants will always try to anticipate what we will do next. But we should not indulge a regime in which market participants are looking primarily to the Fed for their next trade. The economic literature has long described the distorting effects, what it called the Hall of Mirrors problem. If markets rely materially on the Fed's guidance and the Fed relies on market prices, we're more likely to be blinded to new developments, more likely to be caught unprepared, and more likely to commit errors in policymaking. Now, perversely, market participants are unlikely to bear the biggest costs of the Hall of Mirrors problem. The most serious harm is likely to befall those without any financial assets. If the Fed gets inflation wrong and judges the economy wrong, who gets the worst of it? Not the financial high flyers. Hardworking Americans are the ones left to deal with inflation that's too high or jobs that suddenly appear less secure. So, if forward guidance is ill-suited to normal times, How about the new Fed chief commits at a meeting just like this to some explicit reaction function? Surely he could tell us his interest rate path if, say, the data were to come in hot or cold. Well, I wish our understanding of the economy were so precise as to provide a mechanical, tried and true answer. That some simple function, like a Taylor rule, could be rigorously relied upon. But our knowledge just does not extend that far, at least not yet. And other factors most relevant to the proper conduct of monetary policy, they change over time. Providing forecasts to illustrate the Fed's reaction function works better in theory than in practice, better in the lab than in the field. I am not alone in noticing that forward guidance in 2021, to cite just one example, might well have slowed the policy response to high inflation. In my term as chairman, my colleagues and I will endeavor to construct more reliable models, more robust rules, and we'll do this knowing that accuracy in forecasting is still just an aspiration. With so much changing so fast in our geopolitics, global supply chains, technology, it's wise to be modest about what we can and cannot know as we sit here today. In the same spirit, we should receive the full range of ideas on matters that may inform the Fed's monetary policy discussions. If the aim is optimal decision-making, and it should be, we should not crowd out views on the economy. How then to chart a better path to policy? In the balance of my remarks, I will share with you some key principles that guide my thinking on the appropriate conduct of monetary policy. And then I'll offer my promised assessment of the economy. So let's turn first to principles. First, I've noticed in this line of work, yesterday's news has a way of getting mistaken for what's happening right now. The challenge is to know the difference. In other words, we must interrogate reality, make sure we're not setting forward-looking policy based on stale or inaccurate data. Nor should we rely on isolated data points. Trends matter most. The Fed's a decision-making agency. We make choices amid uncertainty, and the data upon which we draw must be relevant, contemporaneous, accurate, and as actionable as possible. Second principle. The Fed's actions are intended to ensure that the aggregate demand side of the economy is broadly consistent with aggregate supply. However, all we observe directly is activity. We never see and can only infer what's really happening on the supply side. Hence, evaluating the current and expected balance between aggregate supply and aggregate demand is imprecise. Third principle, there should be no misunderstanding. The Fed's price stability objective of 2%, as measured by the PCE price index, is a firm, fixed target. Let me be equally clear about another aspect of this objective. Price stability is not self-executing, nor is inflation necessarily mean reverting. It's the Fed's job to deliver stable prices, no excuses. Fourth principle, the Fed also bears responsibility for maximum employment. Achieving both sides of our mandate over the medium term is not an either-or proposition. I do not believe the Fed's dual mandate works at cross purposes. After all, high inflation itself is very harmful to economic prosperity. Fifth principle, short-term interest rates are the predominant tool to achieve the dual mandate. Unconventional policies to spur economic activity may suit genuine crises, of which we all have much experience, but they should otherwise be used sparingly, if at all. Sixth, money matters. I know it's not fashionable these days, But my view is that money has something important to do with monetary policy. We should pay attention to money created by the central bank and money that comes from the banking and financial system. It's true that financial innovations, the subject of this conference, and other factors alter the mechanics that link the monetary base, the velocity of money, and the broader economy. But that is scarcely a reason to ignore the ultimate effects of money on financial conditions and prices. Finally, a quieter Fed, a more purposeful Fed in its communications, is better able to meet its objectives. And we can be held accountable for delivering on our remit, the only true test of our credibility. To borrow a line from General Chuck Yeager, at the moment of truth, there are either reasons or results. So having heard a little bit about AI and general purpose technologies, having heard a little bit about the next policy conjuncture, a little bit on principles, let's turn to the economy today. Given those principles, how do I read the economy? What's really going on outside the window? It's a little ironic. There are no windows in this room, but there are big ones at the Federal Reserve. And we've been using those in my first 100 days, and I expect we're going to continue to use those in the period right ahead of us. Now, you may have read in the July minutes the unanimous view of the FOMC. Labor markets were stable, output solid, but inflation remained too high. A good majority of my colleagues and I thought the wiser course was to await new information in the intermeeting period, especially given possible developments in supply chains, investment flows, and geopolitics, before deciding whether a change in interest rate policy was advisable. And we expressed our joint readiness to act as circumstances, require. For my part today, as we sit here, I'm impressed by the overall performance of the economy, which appears to have strengthened. One indicator of strength is how well an economy holds up under stress, how well it holds up under shocks. On that score, both Main Street and Wall Street have been remarkably resilient. Several other observations. Business CapEx is rising rapidly. The 4-quarter change in investment in equipment and intangibles has been around 9%, its highest growth rate since 2021. And more than half of the CapEx growth can likely be ascribed to the build-out related to AI. What about profits? For the firms in the S&P, profits have grown more than 20% over the past year alone. Profit margins are quite elevated relative to history. Overall equity market volatility, quite low. We're staying keenly focused on market internals, watching performance across sectors. Expectations for both growth in CapEx and corporate earnings are running quite high. I continue to watch the change in the growth rates, the second derivative. The follow-on effects on asset prices, business confidence, consumer incomes and spending are equally important to gauge. Credit spreads on corporate bonds and leveraged loans are near the low end of their historical averages, and issue volumes this year quite strong. Looking beyond fixed income markets to the banking business, in the July so-called SLOOS survey, banks tell us that standards for C&I loans are on the easier end of their historical ranges. That helps explain their growth that we've seen this year in these loans. In my view, credit and loan markets are showing few signs of policy restraint. Now, certain sectors like housing and agriculture are showing strains, but on balance, I would be hard-pressed to describe broad financial conditions as restrictive. Real consumer spending has been healthy despite these shocks, increasing more than 2% over the past 4 quarters. If you combine consumption with the brisk investment we talked about earlier, private domestic financial purchases have also risen. These purchases have increased at a pace of nearly 3% or so far this year. That's a measure that typically carries more signal than GDP. The trend here too, positive. So on the employment side of the Fed's dual mandate, our country's doing well. Labor markets are quite stable. The jobless rate at 4.1% remains low by historical standards and hasn't changed much in a couple of years. Unemployment claims on a 4-week moving average, an empirically robust real-time indicator, are near their lowest level in decades. In my view, the relatively low turnover in today's labor market is partly a result of the significant rematching between employers and employees that happened in the post-pandemic environment. But when labor supply is barely growing, monthly job gains are naturally going to run low. There are always areas of concerns in the labor market. For example, among recent graduates. In general, though, people who want to work, by and large, are holding or finding jobs. They may well be concerned about future labor disruptions, but as of now, I believe the labor markets are broadly consistent with full employment. But on the price stability side of our mandate, the numbers are more concerning. The Fed's preferred measure of inflation, the one I talked about earlier, the 12-month change in the PC price index stands at 3.7%, with a 6-month change a little above 4. The comparable measures from the CPI index are also elevated, as are core measures both of PCE and CPI inflation. And none of these measures are perfect, but they all tell a similar story. Inflation is running above our 2% target. So the Fed's predominant focus right now should be on prices. So what's our job? The job for policymakers is to capture underlying trend inflation. Easier said than done. We want to gauge whether underlying inflation is rising, falling, or seems to be stuck in place. We also want to understand not just the direction of travel, but the speed. Each of these broad inflation measures have fallen significantly from their highs of a few years ago, but progress over the last couple of years has been more modest. And while this summer's PCE and CPI readings were better than expected, they do not tell me that underlying trends have meaningfully improved. The data also show moderate wage growth, but in my view, in tracking underlying inflation, wage growth has not proven a reliable indicator of future inflation for a very long time. So to try to gauge underlying inflation, I want to tell you about a couple things I've always looked to. I find it instructive to disaggregate the 199 individual components of the PC price measure. Over the last 12 months, 54% of goods and services in this basket showed price increases above 3%. This is well below the post-pandemic highs of about 77%, but it remains well above the level of 32% in a couple of the decades that preceded the pandemic. Looking over just the last 6 months, the conclusion is similar. 49% of goods and services in the PC basket showed price increases above 3%. Again, this is well below the post-pandemic highs, but still elevated, quite elevated. The recent rise in overall commodity prices also bears watching. What we need to judge is whether the trends we see indicate upside inflation risks. Now, it matters too whether the inflation readings of the past 5 years have seeped into expectations. The good news is that measures of inflation expectations in the medium term, by and large, look stable. And inflation compensation measures from the swaps market send a strong and similar message, especially in light of recent developments. It's a credit to the Fed as an institution, consistent with the best of the Fed's traditions, that market prices show confidence that we will deliver price stability. And I can assure you, they're right. The thing about market measures of inflation expectations in economic history, I know some economic historians in the audience, is they all tend to look really strong and durable until they don't. These expectations are not pushed around easily, and right now they are very well anchored, but they must be closely minded. And it's the Fed's job to make sure that inflation expectations do not get unanchored. Now, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep. So I've covered quite a bit of ground in the last 25 minutes or so. Let me see if I can conclude this way. I stand here today committed to a discipline, not a decision. My Fed colleagues and I are hardly the first to hold these positions in a time of great consequence. We are determined to redeem the time by doing our very best work. For those of you that know us, you'll know the following is true. We take our responsibility seriously, with humility and with resolve. We know so much depends on the choices we make. Sound monetary policy helps households and businesses to prosper. When carried out effectively, it broadens and deepens the momentum of our economy and helps to secure America's leadership in the world. And I know that our country needs us to think carefully and act wisely, perhaps now more than ever. It's a tremendous honor to serve once again at the Federal Reserve. I'm truly grateful for the encouragement, good counsel, and the warm reception I've received in my first 100 days from my colleagues. I'm also honored and grateful for the views that I've gotten, solicited and unsolicited, from so many of you in this room. For that and for your kind attention this morning, I say thank you. Let's get on with the rest of the program.
That is the Fed chair.
Okay. I don't really know what the hell we just listened to, if I'm being honest. There are so many mixed signals that speech gave. The 10-year's up right now, SPY's flat. Some of these high beta names are taking a little bit of a breather. You're not really seeing the market by any means tank. A bunch of stocks have taken like a 2-3% hit, like a Robinhood. Nvidia's back below 225, but it's not like S&P down 2%, anything crazy like that. The 10-year is up, and I think there's a couple quotes for why we'll discuss its a reaction to it. 4.69, basically at 4.7. My gut reaction, guys, and I'm going to have to read his speech over again and kind of listen to it and go through some of the comments. My gut reaction is that was a hawkish speech. And there's a couple of quotes that kind of explain why it's hawkish. Now, does that mean we're going to get a rate hike? I don't know. The probability is back up into the 40s. It was at 32 last night. So the market is definitely, the Fed futures market is pricing in that a rate hike is more likely than it was yesterday. But it felt pretty hawkish on a couple of different layers. The problem is there was so much freaking poetry involved in that speech. You know, someone said it felt like you were listening to like a Robert Frost poem. It was like there's so many different angles that he was coming at, from perspectives and analysis on the philosophical origins of like the mandate of the Fed and stuff. It wasn't really as clear and direct, but you did get some quotes that were like, oh, this is how it's, wow, 45%. It was at 32 yesterday. It was at 41 when he was talking, 45.7. I mean, dude, you're getting kind of close to 50-50. And at that point, I think the majority of the Fed leans towards the hike. So what is the one quote that I thought felt a bit hawkish? He said he's hard-pressed to describe financial conditions as restrictive. And he said inflation data doesn't suggest the trend has meaningfully improved. I think that's it. And then you had this quote: while the summer's PCE and CPI readings were better than expected, they do not tell me that underlying trends have meaningfully improved. I think that alone is Warsh signaling to the market, hey, inflation's an issue. Hey, the job market's great. Hey, there's all this great CapEx. Hey, price stability seems fine. Consumers are spending. Like, towards the end of the speech, he made an argument that consumer spending is fine. The labor market is fine. PCE and CPI were a little bit better than expected, but inflation is the issue that is not showing any meaningful trend decline. And if that's the case, the only thing the Fed can do, like the only realistic tool they have to be able to navigate that, is a rate hike, which is why the probability just went from 32% to 45%. I mean, I don't think that was a dovish speech. Maybe it's not necessarily for sure on the sign of a hawkish speech that's going to result in a cut. But at the end, when he says, if inflation doesn't calm down, the Fed will do what the wording was, their work will need to be done. I think he said there will be some work that needs to happen, something like that. That's a hike. I don't know how to, like, what other work could the Fed do? They don't really have that many tools in the toolbox. It's a hike or no hike. They're not going to be buying back mortgage-backed securities. They're not going to be engaging in quantitative easing. There's already enough money in the system. So it's literally either they hike or they don't. He sounded neutral. Yes, because there was enough juice in the speech to make it seem like it's not completely going to a hike, but the probabilities for a hike going to 45% are because there was also enough statements in the speech that made it seem like there's a world in which he can hike. Now, will there actually be a hike? I don't know. I don't think any of us knows, but right now it's basically looking like 50-50. The VIX hasn't spiked either. I mean, this wasn't an event that would necessarily create a ton of volatility, especially because he wasn't explicitly guiding for a hike. VIX right there is at 14.27. We're actually down 1%. Rock Lab at 65.54. NVIDIA trying to get back over 225. But it definitely complicates the picture going into September. It definitely complicates the picture going into September. The Michigan sentiment, by the way, 51.7 versus 51. So that was a beat. Current conditions, 51.9 versus 52. That was a slight miss. 1-year inflation expectations, 4% versus 4.4. That was a big beat. And then 5 to 10-year inflation expectations, 3.3 versus 3.3 expected. That was also in line. The benchmark payroll revision last year was 911,000 jobs. This year, 79,000. Which is really good compared to last year. We basically lost 1 million jobs. This year, the BLS is saying we only had to revise our job estimates by 79,000 for the year of 2026. That's great. The problem is that means we probably have a labor market that is so healthy and so secure that inflation can creep up again, which it's already been doing, especially because of oil prices. And that leaves the Fed once again with this question of, if the labor market, which is the second part of their dual mandate along with price stability, is so strong, do we have to hike? Because if people have enough jobs and they're spending enough money and there's enough money in the ecosystem, and you've got oil prices that are up and you've got Apple raising their prices and NVIDIA raising their prices, all that ultimately leads to an underlying trend of inflation that is not going down. That's the takeaway I got from the speech. Does that result in a hike? I don't know. But if you had to guess, it feels like you can't completely dismiss the hike, especially when you're hearing quotes like inflation data doesn't suggest the trend is meaningful. Like, again, when Warsh says inflation data doesn't suggest the trend has meaningfully improved. Okay, premise one, he doesn't think inflation is budging. Premise two, what's the solution? Well, the Fed only has, a couple things they could do. And really, outside of printing money, which they're not going to do because inflation is rampant, it's a hike. But at the same time, you have some other quotes throughout the speech that makes you think he feels, monetary policy and AI deflation is possible. So there's like different layers to this that doesn't make it as black or white as what I think, people would want to see. And so now time will tell to see if this ends up happening. He's not going to hike pre-midterm. I mean, that's also a fair point. Politics tends to get involved in this stuff all the time. 10-year just crossed 4.7. 30 years at 5.1. Ironically, the 30 years actually down, the 10 years up. So you're seeing a little bit of arbitrage in the spread between that. Trump is not tweeting about this yet. So we don't have any Trump reaction. Yeah, he began the speech talking about hiking in the mountain. He already started the speech talking about hikes, which was also weird because he never mentioned the word hike in the context of rate hikes, but he started talking about hikes on a mountain, which is implicitly implying, the type of hike that we're all thinking about, which is rate hikes. So I don't know. I don't know. This was a very nuanced speech. My gut tells me, and the Fed future probability is going higher, tells me they want to hike. Is there a world in which they don't? Yeah, there's definitely a world in which they say, let's give it some more time. But if you hear all these other Fed members being impatient, at some point, Warsh is just one person. Also, by the way, we got to remember, Warsh has always been a hawk. Like, people forget, like, you think Warsh is Warsh has always been a hawk. It's just he's been a bit more rational at times. And I think some of the Fed members might be saying, hey, the rational thing to do is give us a hike. But also he believes in technology, he believes in AI, he sees that sort of deflationary future. It's just if the underlying trends aren't changing, how long is it going to take for AI to really create that level of deflation that's going to get, the market to be more excited? Not to mention these bond yields continue to be going up in the way that they're going up. So I don't know. We're going to see. What do people think? What do people think when you heard that speech? Hike, no hike? Do you feel more inclined to think he's going to hike? Do you feel more inclined to think it's going to be a cut? I mean, what was your raw reaction in the chat to the speech?
The speaks is he provided the functions, though he refused to still provide the reactions. And by that, I mean, he gave us a whole series of data points that we hadn't heard before, things he's looking at. PDFP, private domestic final purchases. He's looking at credit spreads. He's looking at the second derivative of change of earnings. And he's giving us his assessments of those in the current economy. He didn't tell us how he would react to those things, but he gave us some pretty strong hints. Says we have work to do if we're not confident inflation is moving to target. He said inflation is responsibility of the central bank. Recent readings do not tell me underlying inflation has meaningfully improved, and he committed to that 2% target. On the economy, said it was in good shape generally, bullish on AI, and stuck to his guns about providing forward guidance. But, in the terms of what we're learning how to listen to Kevin Warsh, I think we've gotten more. There's a basis to go on here. So I'll just conclude and say it again. We got the function, but not the reaction.
True, Steve, although I would point to a couple of other things there, which may also have been somewhat in reaction to his prior comments. One, just asserting very, very firmly that 2% on the headline PCE is the Fed's inflation target and will remain there, and that the policy rate is the key instrument to try and use to get it there. Those two things he allowed to kind of have a little bit of haze around the last time. And, it seems as if even though he did talk about all this CapEx and maybe it leads to productivity down the road, he didn't lean on it for trying to suggest what the next moves might be in policy.
No, I agree with that. And Mike, it's worth to point out the market reaction here. My takeaway was his overall a hawkish speech in the terms that we can expect hawkish reaction from Kevin Warsh. But if you look at what's happened now, I'm looking at the September probability of a rate hike is now 56%. And I believe it was 30 or 35 before this.
We just crossed 56. It was 45. It is now 56%. So traders are now pricing in a rate hike to be more likely, 56% versus 32% yesterday.
Speech, I am seeing now a December probability of 86%. So this was taken as a hawkish speech, and now we know maybe better how to listen to Kevin Warsh and his ideas about being firm on the 2% target, being firm that inflation is the Fed's responsibility, being firm, as you say, Mike, that the short rate is the main instrument for getting there. The market is taking this as hawkish, and I think it may be the right call here.
Now, the market taking it as hawkish doesn't mean it's hawkish. There's actually two layers to this. Number one, the market taking it as hawkish is actually really good, as Bitcoin's getting a nice little rebound right here, because that means it's going to get priced in. I mean, that's the beautiful thing about markets, right? So if the market's like, okay, cool, we're definitely going to hike. We talked about this before Kevin Warsh was speaking. It's kind of like, all right, you rip the Band-Aid off. We're going to get a hike. Who cares? The world will move on. CapEx will still be spent. NVIDIA's growth is not stopping. The consumer is very strong. Maybe the consumer slows down a little bit off a 25 basis point hike, but I doubt that's even going to happen. The math on a 25 basis point hike is that it takes 12 to 18 months realistically to work its way into the system. So yes, rates move up overnight and things get a bit more expensive, but you need about a year to 18 months to see the actual impact of that. So it's not like earnings decline immediately. And then the market prices it in, which is very good. The other perspective on it is, even if the market thinks it's hawkish, these Fed probabilities, it's a futures market, right? They can change if Kevin Warsh comes out next week and says something that is more dovish. So it's not something that you have to believe is set in stone. But if it is more hawkish than not, and it's getting priced in, and the market's reaction is up $1 on the S&P on a 56% chance of a rate hike, I kind of think that's good. That's like, all right, let's get it over with. We'll move on. And earnings growth continues to be the broader story. The idea that they would actually hike, again, I still can't get on board what they would actually do it. But, you know, as one of you mentions in the chat, part of the reason Kevin Warsh is sounding so hawkish is because he wants the market to take him seriously. That is fair. And the sort of lack of legitimacy or the idea that he's compromised, it's important for him to sound hawkish. But what would really get the market to take him seriously is if he hikes. And I think he knows that. So maybe there's a world in which he actually wants to be taken very seriously and he's going to engage in that, or he's trying to be perceived as non-compromised and he's not actually going to hike, which is kind of where I would lean towards. Like, he's going to be hawkish. The market's pricing it in as hawkish. The speech was obviously hawkish, but it's not actually going to result in a hawkish behavior. The problem is the reality of the inflation data, once again, is what's combated with his words. And when you have multiple Fed presidents saying, look, if the underlying trends aren't changing, we have to do something about it. The literal only thing, in my opinion, that resolves this is ending the war. Because you end the war like in the next couple of weeks or have a massive ceasefire. This FOMC meeting is September 16th, by the way. I think they start voting in a couple of weeks. If oil were to collapse back to like low 70, below 70, I think Warsh can tell the Fed presidents, hey guys, like, yeah, inflation's not really down that much now, but this war is over. Like, oil is 75% of the inflation. Like, if we give it a couple months, we don't really need to hike. And that could be convincing, but you know, is that something that's going to happen anytime soon? It would be quite ironic, man, if they give us a hike going into the freaking midterms. They did that in 2018. They did that in 2022. If they actually do it again in 2026, it would be more poetic than Warsh's poetry at the beginning of that speech. And that would lead to some level, if history is a teacher, of decline into October, but that would be the dip to buy. And so we just have to see if that actually ends up playing out. The job revisions, again, they came in at 79,000, so way lower. The market was expecting around 200,000, so it actually came in way lower than expected, but it continues to prove that the labor market is in a good spot right now. Consumer sentiment was at 51.7 versus 51, and then the one-year expected inflation was at 4% versus 3.4%. That was actually worse than expected from the Michigan consumer survey. SPY actually getting a nice little move right here. I mean, this is the beauty of this rate hike being priced in and being behind us. Moderna is getting crushed, by the way, down 6%. It's ironic, though. SPY is going up, but like nothing that contributes to SPY meaningfully. I guess Google's up. Nvidia's still down. What about Amazon? Oh, Amazon's getting a nice move, 3%. What about Microsoft's up because of software. Microsoft's having a great day today, so that's not tearing it down. What's the other one? Apple is having a great day. Wow, your Mag 7's coming back. Your software name's obviously doing great. Nvidia is the only one. Nvidia's got to flip green. I would imagine Nvidia flips green if all the Mag 7 are partying. Google's up 2%. ServiceNow's up 4%. Uber's up 2%. Netflix is up 3%. So what's down? Micron? No, Micron's up. Nebius is down. So some of the neoclouds are down. Some of your photonics plays are down. Actually, a lot of your semis are down. ARM, Lam Research, Dell, Taiwan Semi, Qualcomm, ON, ASML, AMD, NVIDIA, SMCI. But your software names and your hyperscalers are green. Bitcoin didn't love the speech, but as you can see, Bitcoin's rebounding from the speech. So it fell from 79.4 down to 78.5, and it's right back up to basically 79.4. SoFi didn't like the speech either, but you know, at least SoFi is above 1850. A rate hike might make the Mag 7 consider going into debt for CapEx, and investors might really like seeing an end to this. Yeah, but the thing about a rate hike is the Mag 7 don't really care, right? Like 25 bips, 50 bips, even 100 bips for the Mag 7, like they have more than enough cash flow to deal with that type of debt. Granted, yeah, you're right. Like if the Mag 7 actually pulled back on CapEx, that would be something investors like for a variety of different reasons. Free cash flow going positive is one of those, but I doubt they're going to do that. I think Jensen's earnings told us they're not going to do that, and 25 bips shouldn't affect them. That's the thing about the 25 bips. Like, I kind of like the idea of having a hike because it would get priced in, or at least the perception of a hike being priced in is better than not, because it shouldn't be this big boogeyman that's like out there. It's 25 bips. Like, yeah, it'll make things a bit more expensive. It will obviously affect the economy. It's definitely not going to help the housing market, that's for sure. But it's not like it's going to, stop the earnings growth. It's not going to stop CapEx. It's not going to stop consumers from spending. It's definitely not going to stop our debt problems. If anything, it might motivate Trump to be like, all right, if the Fed's really going to be against me here and it's my guy that I picked, like, I've got to do something about this Iran war so that they can get back to cutting. Because to be honest, if you would tell me we're going to get 2 cuts in 2027, but we have to get through 1 hike first, I'll take that. If we have to go through a little bit of pain to eventually get the cuts, that's okay. But if we have to be in this purgatory every freaking month where we're wondering if we're going to hike or not, I think that's just going to create more volatility. Here's Lizanne Saunders and her perspective on this war speech.
Equation, less off the inflation side of the equation. So higher yields typically meant higher growth without the attendant concern about or risk of inflation. That's sort of nirvana for equities and vice versa. But for the 30 years prior to that, mid to late 60s up until the start of the Great Moderation era, that relationship between bond yields and stock prices was the complete opposite. You had a negative correlation because bond yields were keying more off the inflation side of the equation, less off of growth. Now, that, of course, means that during that era, which we've been terming the temperamental era, bond prices and stock prices generally moved in the same direction. And I think we're already back in an environment like that. It just changes the discussion that everybody needs to have around, all right, how do you get diversification relative to the ease of a 60-40 portfolio in the Great Moderation era?
I was just going to say, are you declaring 60-40 dead for a while, and what replaces it?
No, I think there's still a home for most portfolios for both the equity side of things and the fixed income side of things. I just think the simplicity of that type of analysis, I never really thought 60-40 made a lot of sense. It's a generic way to talk about stocks and bonds being diversifiers. But the good news relative to the temperamental era in the 60s to the 90s is that we've democratized, and by we, I say that generically, but to some degree, I also say it as it relates to Schwab, democratized investing for the individual. And that's inclusive of access to myriad asset classes that can provide that diversification in a slightly more sophisticated way. Individuals, not just necessarily high net worth individuals, that can take more of that sort of endowment approach. Systems that are in place and fund structures are in place to provide that diversification where you look for non-correlated assets. So that is also an important difference from the temperamental era, is access to that diversification array. And I think that's beneficial for all investors.
And I do think it's probably worth also getting more specific. When you mentioned that temperamental era, pre-2.
Okay, you're seeing the advertising names really get some love right here. Mr. Meta and AppLovin waking up a little bit. AppLovin 334, nice 7% day. Now, this is also probably because software is getting a massive bid. So AppLovin getting some love right there. But Meta, I mean, can we break 590 again? 586, look at that, just up and to the right. 574 bottom, which was about 15 minutes ago. That's basically when Warsh ended his speech. A lot of these stocks started moving higher when Warsh stopped talking, to be honest. Yeah, literally Amazon. Look at this. Amazon immediately rocketed up right there at 10:30 when Warsh was done. And you started to see some more green. Zeta doing well. The software names, unbelievable resilience in the face of all of this. Micron's up $1. Nebius is still down. I'm kind of surprised Nebius is not moving with Micron at all here. TSM, ASML, all of these are still down. Your hoods took a big hit when Warsh was talking. Even hoods starting to recover now that Warsh is not talking anymore. Rug pull incoming. I don't know, man. If they actually rug pull after the speech, it is what it is. But yeah, hood was at 105, now at 108. This market is such a weird pair trade. AI topped in June, SaaS bottomed in June. Yeah. And that's literally been the story over the past month. Look, ultimately, if we have to rip the Band-Aid off and hike, the one thing about the market is that they will absorb it and move on. And the way they're pricing it in the Fed future probabilities, but stocks not reacting unless we get a rug pull, is almost like they've accepted if it happens, it happens. And the market can change its mind really quickly. S&P high of days right here. So it literally it bottomed when Warsh was talking. 769. Warsh gets off stage, stops talking about windows in the room, and the market moves up. Netflix also getting some love. There you go. Traders now see September rate hike more probable. U.S. sanctions are targeting Iran in different sectors again. Okay, so we have some more sanctions. U.S. Treasury imposes limits on an Egyptian bank for doing business with Iran. Oh, that was the financial institution I think Besant was talking about earlier this week. U.S. Treasury imposes limits on Egyptian bank for doing business with Iran. Okay. I mean, if they're going to keep using this whole economic pressure scenario. Apple at 319, that's up 1.7%. And then Meta continuing to make its move. Yeah, I mean, I guess the best thing out of this is that we got it over with. He said what he said. The statements were hawkish, but it doesn't mean it has to be a hike. It makes you think the only solution that's left is a hike. But if it's not going to be a hike and the market's perceiving it as hawkish and the market's moving on from it, then we can go forward. And that also gives them 3 more months to end this war and then for oil to come down and for inflation to start making its way down. So if they can just avoid September and Trump can end this thing by November, by December, there's a really good chance, not for a cut, but definitely for Warsh to flip to being way more dovish and citing that oil prices coming down basically 25% from here give them enough confidence that inflation is under control. That would be like the best case scenario going into, I think, the end of the year. Nike's up almost 2%. The Windows line was low-key a bar, though. It was low-key a bar. It was kind of an admit joke, but it was low-key not too bad. Let's get a little bit more commentary on Warsh, then we'll keep going.
Bloomberg and like save all kinds of like time and effort, etc. There could be an imagination.
So what are you doing? What are you doing? I mean, the truth is, not only do we enjoy the environment, but it's also wonderful to get the tangible sort of discussions
and you mean a lot.
Innovation. What's this? That's what the papers are about, right?
Stablecoin. We're talking about the use of the dollar in stablecoin.
A lot of people don't believe any of it. Kate Moore's here believing in productivity. With all the interviews you do you believe in productivity?
Do I believe in productivity?
Yeah, I mean,
but they're both incredibly productive. I think they're demonstrating
I like to say that in my daily work, I sometimes witness productivity. But no, productivity, obviously a huge topic, because for Warsh especially, it's like his giant get out card, right? If we do get the productivity boom, if that ends up as a deflationary force on some prices, like then he really doesn't have to be as hawkish as he might otherwise not want to be. Do we see evidence of it right now? Not yet, right? Like in the numbers that we're looking at, I don't think we've seen the big productivity boom. It's this kind of thing that's always coming down the road, but we talk a lot about it, but we have yet to see it in the actual numbers.
For example.
And I think that's also why Warsh is so keen on this AI thing, because as she said, if we get productivity, he doesn't have to hike. Meta getting a red candle at 589, now at 586. But if the market is more productive, naturally that's going to be a deflationary spiral, even if the labor market is strong, because you will have an advance of goods and services, which will catch up with demand. And if supply and demand stabilizes, I mean, you're just not going to have that type of inflationary pressure that we've seen over the past 2 months. Zeta right there, up another 1.2%, trying to go back for 31. But at this point, a lot of his comments just felt a bit more geared towards the hawkish side. I do think, though, there is a meaningful argument to say, hey, he wanted to get the market to think that he's hawkish so that the market stops thinking that he's just like a puppet. And he doesn't actually need to give the market a hike to feel that. Microsoft 514 topped out at 520 2 weeks ago, making a nice run to come back there. And that could be kind of how this plays out as well. Sandus now green, Micron now green, Robinhood trying to flip green. Yeah, dude, I think the real rug pull today was actually going short during the speech, to be honest. I mean, it's a long day left. We'll see if this thing flips back red, but like the real rug pull was around 10, 15-ish. If you went short thinking that the sentiment from Warsh, which was hawkish when you were listening to it, was a reason to just sell everything off. Like, this is how the market humbles everybody. It tends to go the opposite of what people think will happen. So if you expected a market reaction to go red because of a hawkish speech, the exact opposite happening right here is pretty much exactly what the market would do in that scenario, because the logic is actually not that irrational. It's getting priced in. That's it. It's like when a company has bad news. It's like, all right, at least it's over with and you can move on. And any piece of good news now is a catalyst to go a bit higher. Amazon, a nice $9 move right there. Hasn't had a 3% day in the past couple of weeks. AppLovin 7%, Zeta 1, Micron still stuck at 939, but still up almost 0.5%. And then Nvidia, very close to trying to flip green. I went short yesterday, but I closed it to a long last minute. Yeah, I mean, the short definitely worked going into the speech, but like, this is what I mean about like intraday shorts. Like, if you shorted Hood at 109 at 10 and covered at 105 at 10:15, a great trade. But holding on to it when the forces of the market are taking it a different direction, it's just like you can't be stuck in that overnight. And if you are, you just have to hope that the forces completely switch to the opposite direction across the entire market. Meta right there, 585. Trump is live. There's no way he's live, bro. He wasn't scheduled to go live today. At least I didn't see he was scheduled to go live today. Where is he live? I don't see him. Let me see. Where is he live? Where are you guys seeing? I don't see him live. No, he's not live on the White House channel. He's not live on... Oh, Trump honors Artemis II crew and calls International Space Station from Houston. But the stream is not up on the White House channel, so I don't see that there. Cactus, do you know if he's in front of an audience? Because if so, then... No, this is not an audience thing. He's going to like call in, I think. I see the thing. Wait, is he actually... No, he's going to be calling in. He's not going to take questions or anything like that. Yeah, so we're probably not going to get any quotes or anything. Okay, let's see what else we have here. Jensen Huang just passed Larry Ellison and Mark Zuckerberg in net worth with only a 3% stake in Nvidia. Wow, really? Jensen Huang net worth 196 billion. Zuckerberg, who owns a lot more than 3% of Facebook. Yeah. 196.2. Jensen's at 196.8. Wow, that's crazy. Only 3% of Nvidia, but it's compounded so aggressively. $196 billion. I mean, compared to Elon, that's not that much, to be honest. But that's why Jensen increased the dividend. Yo, Zucks is going to get $780 million of dividends this year from Meta. It's like $1 billion of dividends. Jensen's also going to start getting some more divvies as well.
Consumers and businesses have proven to be remarkably resilient amid recent shocks. And for the first time, Warsh provided details on indicators that he's watching to gauge the economy, really reacting and meeting critics halfway who said he had not offered enough information on his thing. Here's a quick list of things that he's looking at. PCE inflation, 12-month and 6-month indicators. PDFP, a gauge of GDP growth. Credit spreads, which he said are not blowing out. growth in earnings showing resiliency in the economy, and inflation breadth. That is the percent of indicators in the PC that are above 3%. He didn't like those numbers. Well, look at how the markets reacted to probabilities here when it comes to Fed hiking rates. In September, up to 57% now from 35 before the speech, and getting more and more confident of a hike as the year goes by to 86% come December. Warsh stuck to his guns, though, when it came to his views about communication, the Fed not telegraphing where it's going, saying a quieter Fed, he thinks, is a better Fed. But he did show he's willing to offer more on his economic views than he had in the past, Carl.
Steve, long end, 516, 10-year down a bit. You think the long end is a believer here?
I think the long end is thinking about believing it. I think that's part of what has to happen here. Look, remember, he didn't guarantee it. He didn't say we're going to be hiking rates. He's still a little bit circumspect about those rate hikes. The market thinks he's closer to doing so. And you have to have a couple more months of inflation indicators here. There's going to be an adjustment to the methodology of one of the indicators the Fed watches. So the market, I'd say the long is a little more confident of rate hikes, but still a little circumspect, whereas the 2-year and the shorter duration, well, they're going to be much more affected, but obviously, if the Fed hikes rates here. So they're going to be much more sensitive. And that's obviously why you're getting that more reaction on the short end than the long end. I am a little surprised, given how hawkish I thought this speech was, that there wasn't more reaction on the long end, but we'll have to wait and see.
Steve, look, now there's the 2-year hitting the 4.284. The dollar hit a session high, gold hit a session low. What are the markets hearing that Warsh did not explicitly say?
Well, I think the market is hearing the things that Warsh explicitly said. Like, you would expect gold to fall if they think the Fed is going to be more hawkish. You would expect the dollar to rise if you thought the Fed was going to be more hawkish. The actual outlier here is the long end. You did get a couple basis points move there, as Carl pointed out, both on the 30 and the 10. So the market is pretty consistent, I think, in the signal that it heard and the way that they think that Chairman Warsh is leaning. Look, I was trying to describe, you have to listen to Warsh on his own terms in the following sense. If you imagine a person who whispers and then says one word louder, well, that's the word you listen to. When it comes to chairman and Fed talk, Warsh is a whisperer. He doesn't want to talk very loudly, but he doesn't want to talk very much at all. So you have to take him on his own terms. And on those terms, in this regard, this is a hawkish speech that indicates or suggests the possibility of rate hikes, but of course doesn't guarantee it.
All right, Steve, thank you for bringing that from Jackson Hole. For more on what we've heard from Chair Warsh this morning and for the impact on markets, let's bring in our panel. David Bianco.
So once again, markets basically, to an extent, pricing in what he said. You're getting some red candles popping up across the board, but overall, NVIDIA not really able to break out from 226, once again, going red. Amazon having a great day, dude. I don't think Amazon's had a 4% day in a long time. It has been a long time. Yeah, 55.7% chance now on a rate hike. Mike, and thanks for the super chat. I think Micron's going to go higher. I think it should go higher, given the multiple that has been compressed. But I think the market has been very moody with the neoclouds and the memory names. I mean, I am ready to buy DRAM again if it gets below my cost. So it needs to go another $3 lower for me to buy in again, which means Micron has to be at like 880, I think-ish. And if it's not going to get there, then it is what it is. But a lot of this stuff is, the volatility has been taken out, right? So I think a lot of the activity is just, I mean, dude, Micron being up 0.65% in April, May, June, or July. I mean, this stock was up almost 4 to 5% every other day. And in the days that it was not, it was up at least 2%. And then it would take one down day, and then it would just recover the next day up 7 or 8%. Like $6 of volatility is not what you had on Micron for the majority of this year. So the fact that that's just not getting that type of excitement, that's actually a good thing. I think it's consolidating, but it does mean it's hopefully getting ready for the next leg up. Service now 145, as that's up 5%. And that continues to make a bigger move. And Google and Amazon finally having a fun day. Google almost, wow, quietly making its way back to 350. This thing was at 337, I think, on Tuesday. Bloom also trying to get up to 220. And then Amazon potentially quietly making its way to 270 as it continues to get a bit more excitement. Let's see what other core macro news we have. We talked about the job revisions. Someone just bought 2 million of Marvell puts, 215 for September 18th. So you have some put flow coming in on that. Talked about the U.S. sanctions. I mean, this Kevin Warsh thing was the big news today, and that seems to have now made its move. AAOI, this one got hit with dilution last week on Friday. So that's why this one is taking a hit. But it is still red. Chris, I see you in the chat. If you are free, let me know. I'll send you a link. We'll end out the stream with getting some of your thoughts on the Fed and memory and some of these software names. If not, then no worries. Trump is about to be live. He's going to be doing this celebration and medal ceremony, so I don't think we're going to get much from him in terms of a reaction to the Fed or Iran or anything like that. But outside of that, yeah, I mean, after Warsh on a Friday, if we don't get a rug pull, I'll take it. I mean, it's a relatively decent reaction with the hyperscalers giving a lot of love to the S&P, even after Warsh was a bit more hawkish than not. Why are the hyperscalers going up? Is a rate hike priced in bullish for them? It's not bullish, but the pricing in of the rate hike takes away, I think, some of the bearishness. I think it's indifferent to them. Palantir almost 187 because their cash flows don't really get affected by a 25 bips move on paying their debt. It affects the U.S. government. It affects the neoclouds. It affects small caps. Where's the Russell? Is IWM red? Wow, IWM barely down, dude. This is the index that should be getting hit if the market was really afraid about rate hikes. Down 0.5% is nothing, bro. This I mean, if anything, the market is telling us they're pricing it in right here. 187 on Mr. Palantir as that continues to go green. I missed the semis rallying with the Max 7. Well, remember the semis, when they rallied, the Max 7 didn't rally. Like that was kind of, do you remember the Melius Research sell-side report? I'll never forget reading this. And I felt like I was going crazy. They were like, why would you buy the hyperscalers when they're spending all their money on memory? Buy Micron, $2,500 target. The dude was literally like, sell your Google, sell your Amazon, sell your Meta. We see no reason to own the hyperscalers. You should buy the CapEx beneficiaries. And it's like for someone on Wall Street to actually put that in writing and say, sell the greatest companies in the world and buy a memory commodity supplier, even with all the bullish sentiment around memory. Like that was the literal top, which was the bottom for the Max 7. It was so ridiculous that that was the argument they were making. Not to say that Micron needs to go down. It's just like you can own both. Like one does not have to trade off with the other to such an extent that you're advising clients on Wall Street to sell the Mag 7, the ones that are spending all the money. And they're spending it for a reason. They're not spending it for fun. And buy the thing that's getting the money. But that was the story for the majority of the year. Like the companies that were spending the money were not benefiting. The companies that were getting the money were, which felt kind of stupid. Like maybe Micron didn't need to go up 10x. It could go up 7x. And, Meta doesn't need to fall 30x for spending a ton of money on Micron. Like they both should benefit. One should benefit from getting the EPS growth. The other should benefit from getting the revenue growth because they're spending so much on the infrastructure. And I think that's what's happening right now. Like if one thing goes up 10x and the other thing goes down 50%, I'm using hypothetical numbers here. Maybe the thing that went up 10x is now going to take a breather, and the thing that went down 50 is going to kind of get back to normal, which just means the semis are going to chill out for a bit. Oh yeah, where's Build-A-Bear? Build-A-Bear is up 5. Burry bought more of it yesterday as he continues to be short in Vita. Yeah, VIX back down to 14. I mean, this market is taking those comments with a grain of salt and not really, either they're not expecting the hike, or if they are expecting the hike, they don't care. And I think both scenarios are great for us. Obviously, no hike would be the best, but if we get the hike and it just doesn't really make an impact, I mean, like, okay, we move on, get through the midterms, and that's it. get back to earnings growth, because that becomes the big story. Do software companies have better cash flow than the Mag 7s? Yeah, because the Mag 7 are going negative, but in general, no. The Mag 7 have like massive free cash flows, but the SaaS names aren't spending that much on CapEx. So for now, it's a bit better. Is Build-A-Bear bullish for a rate hike? Well, their sales were lower than expected, so technically we might not have to hike rates if the consumer's struggling with Build-A-Bears. Has anyone ever gotten a bear from I think I've been there like years ago. NVIDIA, goodness, are we about to lose 224? But I don't think I ever got one of those. And NVIDIA 20 cents away from losing 224 again. Okay, so I haven't seen Zitron on Compound and Friends. Does anyone have a good moment from it? I want to find a moment where Josh Brown really challenges him, bro. If they don't challenge him in this podcast, it's not going to be fun. They have a section on NVIDIA. Okay, let's go to it. Let's see. Let's see if there's some back and forth after these NVIDIA earnings.
44% of their first half of fiscal 2027 was 3 customers. 5 customers make up 70% of their accounts.
Can I jump in right there?
They're good customers.
Well, can I jump in right
Are
there?
they? Because they don't name them.
Well, we know who they are.
Do we?
Well, we might not know who.
Okay, that in and of itself is, what is he talking about? They don't name the 5 customers. It's like, brother, are you stupid? Who has the money to spend hundreds of billions of dollars on NVIDIA chips? Are you really going to nitpick and say they don't name? It's Meta. It's Google. It's like, this is the type of stuff. Like, I'm 20 seconds into it, and this is where I get kind of annoyed, because I'm like, that's what you're going to complain about, that they don't name the customers that are obviously the hyperscalers? Like, who else is buying the GPUs? Like, this is the part where it's like, okay, some of these arguments are just like, there's not much meat on the bone here in terms of substance.
Because they don't name them.
Well, we know who they are.
Do we?
Well, we might not know who's 16 and who's 12, but we know the.
Yeah, but if one of them is Oracle.
But hear me out. That's their immediate customer.
Yeah.
But those customers have millions of customers. And that's what this. In other words, you don't have a hyperscaler spending on NVIDIA chips to serve itself, except in the case of Meta.
Yeah.
Right. They're serving Fortune 500 businesses, governments, sovereigns, et cetera. Those are their customers.
But the point I made about Microsoft's AI revenue is where this comes in. So fiscal 26, which just ended, $34.33 billion of AI revenue. 24.1 billion of that is OpenAI. That means that selling GPUs to anyone else other than their large fail son is a single-digit billion business. Microsoft is the apex predator of software sales. They have hundreds of thousands of resellers. They have tens of thousands of salespeople, and they can't scrape together more than single-digit billion dollars of sales for Copilot and all the stuff. And this is on top of the fact that GitHub Copilot, one of their only successful AI products, has now gone token-based billing, which means people were before able to spend $40 a month, spend $5,000 of tokens. Now the token-based billing.
Now it's usage.
Gone.
Usage
Gone.
based.
That business is dead.
Right.
And on top of all of that, wow, $260 billion in CapEx, and all of that Fortune 500 demand, drew on, like whatever it may be, is what, $10 billion a year?
Satya Nadella would say, give us a couple of years.
Why do I have to give? Sorry, but the point is like, we've given him a few years, and this is the best he's got for us. We have OpenAI is a liability now. Like they are material enough that Microsoft actually has to, I think, what's like 27% they own of them. It's actually a deeply load-bearing.
They have to consolidate their financials onto their own income statement.
And the other thing is Microsoft's only getting paid if OpenAI can keep raising money. And OpenAI, it has a shrinking amount of people to raise it from. Their last round, $122 billion, only $12 billion of that came from venture capital and the very same asset managers who were funding data centers. $110 billion was NVIDIA, 30, SoftBank 30, which put them into financial dire straits, and they're still there. And Amazon, $50 billion. That's not going to happen multiple times. Or if NVIDIA invests again, they said they wouldn't. They literally said the words. If they invest again, it's bad times ahead. So Microsoft's growth is dependent on OpenAI and now Anthropic spending. Outside of that, they don't have significant demand. This isn't even an opinion. This is a Bloomberg article that spelled this out. And if you go and look,
was it Bloomberg opinion?
It was Brody Ford, I think. But it was also based on the actual earnings documents.
Microsoft doesn't have the demand for its own AI native products from its own customers
at the scale that they would need to justify. Like, I'm not saying there's zero demand. They have found, but this is also after them
I just don't think the numbers make sense of that. They're growing Azure at 40%. Azure is AI workloads on cloud. Now, you can make the argument that GitHub Copilot, as NVIDIA loses 224, is not the most compelling. That's fair. And look, you can complain about OpenAI and Anthropic every single day. I mean, we do that all the time in citing the bear case. That is not an argument for broader AI demand not being. I mean, those workloads have to happen on some type of cloud computing backend. GCP, Azure, AWS, all growing upwards of 40%, GCP at 80%. The demand is coming from somewhere. Now, if you say it's only isolated to OpenAI and Anthropic, you can make that argument that they are a majority of the backlog and that they have their own liabilities. But that is not to say that there is no demand, which is kind of his core argument. Like, if you listen to him on Diary of a CEO, he's like, the LLMs don't do anything. No one's using them for anything. That's not real. It's like, okay, you can make that argument. But then if you look at the cloud growth rates, which are a direct reflection of AI workloads, which means increased demand, it's a little bit of a different scenario that it's painting here.
Their customers and their massive sale. I must be clear. Microsoft sales teams there's only one level higher of more annoying, and that's Oracle. And Oracle is a whole other problem. But the point is if this was a case where 30% of their revenue was OpenAI, I would be like, all right, maybe my business is kind of falling apart. 70% of their AI revenue being OpenAI is existentially bad. They have $250 billion of Azure spend committed to. That's so much. Microsoft was $331 billion, I think, last fiscal year.
But now they've divorced themselves from the exclusivity agreement with OpenAI,
which only makes it worse because now OpenAI needs to spend $138 billion over 8 years with Amazon, $20 billion with Cerebras, $22.4 billion with CoreWeave, $300 billion plus with Oracle. They're spending. This is the craziest thing. Stephen Ju from UBS had an analyst note. They're spending like $12.5 billion a year at Google. I didn't know this until very recently. It's weird that it's not being reported very well. But the thing is OpenAI, Sam Altman has one real talent, and that's signing his name. My man loves signing contracts. And the thing is, the problem that everyone has right now is you can only really think a quarter, 2 quarters in the future. You can't, because even like, it's going to happen in 2028. NVIDIA will get to 674 billion, I guess it would be, based on consensus for fiscal 28. So NVIDIA will get there because right now, NVIDIA makes lots of money. It's not a problem now. To get there, NVIDIA is going to have to basically take 3 to 5 customers. They're going to have to find way more debt, like way more, because the price of debt is increasing, but also NVIDIA just bumped up prices 17%. The cost of memory is skyrocketing. And on top of that, you have a shortage of talent, shortage of electrical grade steel. There are all sorts of things stacked against NVIDIA here. They could pull it off, but I don't know how they're going, the actual money.
Yeah, again, they just guided for 70% growth. I mean, a lot of these things, these are kind of abstract concerns that are not rooted in the numbers. And like, he's not talking about the numbers on NVIDIA earnings. And I wish like Josh and Batnick would kind of push back on that, because you have to make the case on why the street thought it would be 40 and they're guiding to 70, which means the CapEx will continue, which means the demand for the ROI is there because the CapEx is like, NVIDIA's not forcing Microsoft to buy GPUs. Microsoft is buying GPUs because they have the demand. So when the concerns are as abstract as they are and they're not rooted back in the numbers, like there is a major disconnect. And that's what I think Zitron's never challenged on to actually defend in any meaningful way.
That needs to get raised is astronomical.
But so Daniel, chart 5. Ed, if somebody said to you 2 years ago that this is going to happen, you would be saying the same things that you are right now about how implausible it would be. So what we're looking at for people that are listening is the trailing 12-month net income for NVIDIA just screamed past Apple.
But how much of that is equity gains, though?
What does that mean?
As in their investments in Anthropic, OpenAI. They've invested in like CoreWeave, Nebius, Iron. They have a bunch of equity investments that help bumping that up. To be clear, I was wrong back in 2024. And why? Because I was fucking naive. I was like, the market's a sensible place. Microsoft and Google, Amazon, Meta wouldn't spend hundreds.
Oh, the majority of that net income is not padded with Anthropic and OpenAI. The majority of that net income is the 75% gross margins and 50% net income margins coming to the bottom line. Like, you see what I'm saying? He's like, well, how much of that is Anthropic? It's like, hold on, not a lot. Like, how much of that is SpaceX? It's like none of it. Like, these are actual gains that they're getting because of selling GPUs at some of the best prices that a company could ever sell them at. It's a very abstract concern applied to numbers when you bring those up. And barely any of it is buybacks, because NVIDIA just started buying back stock. Like, a lot of that is just money coming down to the bottom line, which is why NVIDIA is the world's most valuable company. And then esoteric complaints about what they're doing with private investing. They also didn't even invest in Iran. He's like, oh, how much of that is Iran? They have a warrant to potentially invest into Iran, but he's wrong. They haven't put in money in Iran. If he said CoreWeave, that's a different question. But like, even things like that, those details that he's just like throwing out there shows that he's not actually looking at the specifics of the numbers or the details in which these companies are producing these numbers.
It's billions of dollars for no goddamn reason.
Wait, so you were wrong because the market's stupid?
I was wrong because I was stupid. I was wrong because I was naive about how the world works, and I've had to take a harsh...
You didn't think they would take it as far as they've taken it.
Exactly, and I didn't think that the debt system would support it. So yeah,
So what do you think the market is getting wrong right now? Because I think everyone knows that OpenAI is a potential problem.
Yeah.
Look at Oracle stock; it's down 70%, still on the mat. Even as software stocks are bouncing,
Yeah.
Oracle has caught no bounce. So what do you think the market is misunderstanding that you're seeing?
The thing I said about the centralization of data center demand, OpenAI, I think, is like 60% of all AI data center demand. Without OpenAI, there is not another OpenAI-sized spender. And the only reason there is an Anthropic or OpenAI-sized spender on AI compute is because of the availability of venture capital dollars. So without that, you can't, like, the demand isn't there. The market isn't seeing that because it hasn't happened yet. The quarter, 2 quarters think they're doing where they're like, well, the money's still coming in. Because what, I kind of said this already, but the amount that Anthropic and OpenAI has to spend has to increase by like 10x.
Well, their revenues are increasing, and those are real revenue dollars, and they're both going public in the next, call it 6 months.
Well, you just made a face. Anthropic's doing 60 billion. Is that
No, they're
real?
not. Run rate.
Go.
Run rate.
Okay.
This is the biggest scam of them all.
What? ARR run rate as opposed to last quarter.
That's the first part of the scam. So ARR used to mean annual recurring revenue, referring to if I have 10 100 million contracts, I've got like $1 billion a year. Easy peasy. That's annual recurring revenue. Wow, how amazing.
That's SaaS.
SaaS. I probably f***ed up the math there, I realized, but whatever. Moving on.
Yeah.
And how they're booking their revenue, you probably don't like.
Well, now they're calling it run rate. And run rate can have... Anthropic has never defined this. Even Bloomberg in the 65 billion story didn't define it. It can mean 4 weeks times 12 or 4 weeks times 13. The problem is Anthropic and OpenAI are both annualizing token spend, which is not it's not a software subscription. It's not recurring. A customer could spend 1,000 this month and then spend 50 next month, especially if they're moving to open source models.
Sorry, that's 100% true.
Mm-hmm.
But every publicly traded corporation that says anything to Wall Street about its spend,
mm-hmm.
the only thing you ever hear is we already ran out of our compute spend and need to spend more.
Yeah, that's because Anthropic and OpenAI are taking up most of the compute infrastructure, so there's not enough. There is more demand than there is right now. The question is how much more? Because I don't think that, I mean, I kind of estimated in a newsletter a week ago, I think there's about $22 billion of compute demand. Sightline Climate said back in February that was 190 gigawatts in planning. That's about $1.5 to $3 trillion a year in compute demand they'd need. There is a complete economic mismatch, and it's stark.
You don't like ARR run rate because it's just a extrapolation
of it's a snapshot of a period in time,
and then
that they define
pulling it out to like a year.
Yeah, so we also don't know what the period. We don't even know what it means. They never define it. Anthropic has used it several times in their own announcements. They never define it. It could refer to, hey, we just
look. I think this claim about ARR, that's a fair claim. I think that's reasonable to say. You can't judge these companies based on ARR, but to say there's $22 billion of AI demand in the system, I don't know what to. I don't understand how you make that claim. Like, I don't get it. I don't. NVIDIA just did a lot more than $22 billion of revenue, and I would say NVIDIA is selling stuff that has to do with AI demand, right? So again, some of this stuff, it's like, it's just not really rooted in numbers. Other things we could definitely complain about when it comes to OpenAI and Anthropic. I think those are fair critiques, but the bulk of the argument can't just be those two companies. And if it is, that's fine. But he goes as far as to say none of this is real in and of itself, and I'm not sure that's the best claim.
Release the model and everyone's trying it. Hey, we just did a new feature and everyone's buying a new subscription. Oh, on this day, we lost a bunch of subscriptions. So we'll pull the period over here so we look bigger. It is not a trustworthy measure of a business. And the fact it gets accepted is an insult to investors' intelligence.
So who's the idiot here? Is it the CEOs and the boards for all of this CapEx? Is it the equity investors? Is it the people loaning the money to build these data centers? Like, who is not seeing past their nose right now?
Lenders. All of the investment in AI data centers terrifies me to my core. It's so bad. These things are like miniature cities. They condense city of Bristol in England, using this as an example, about 1.25 billion square feet. Takes about 800.
All right. If you guys want to continue watching it, I will link that there. I'll try to get through it and see if I can get more arguments. I listened to him on Diary of a CEO, man. There were some moments where it was cringe. It was like just him not acknowledging anything is real when it comes to AI. There are some valid concerns. I mean, there's valid concerns that I talk about on the show all the time when it comes to Anthropic and OpenAI. But there's other things that are just like, there's a little bit of a form of attention that I think he wants by making something very salacious in terms of his claims. And when you say all of it is fake and completely deny the numbers or just completely get the numbers wrong in your analysis, that's where you start to see that come up. Christopher Patel. Good morning to you, sir.
What's up, sir?
Dude, not a bad day with Mr. ServiceNow doing its thing.
I feel vindicated on ServiceNow. Like, this was one of those times where there was a lot of doubt that like people had when it came to. I was just like, I'm glad that we had that conversation in that day when we were driving and you were like, talking to me about that thing with memory, the idea about investing in that company. And I was just like, and I remember at the tail end, me, you, and one of our friends, we were talking about it. And it was just like, we work with this stuff. Like, we're not seeing any deceleration. So I don't know why the market is just out here trying to say that this is like done and it's cooked. And it just made no sense. And I guess I'm glad that I have that like experience being in that front line. That gives me a little bit more insight than just some random person talking because they have no idea or clue on what's happening. Are
you taking profits here or letting it ride?
No, I'm just going to let it ride. But I just want to highlight one thing. I think basis points and what you do right now on YouTube, that is one of those alpha points that I think people should really appreciate, because you have a very wide variety of people that you're bringing on that give different perspectives. And a lot of times people work specifically in an industry. And when you work in an industry, you can actually get what's actually happening versus what the market is just saying. Right.
Yeah.
So there's so many times. I mean, remember, it was the same thing that gave me my alpha in United Healthcare, because I was like, I work in healthcare. I see, like, I know this business. And the thing is, like, unless you work in it, you have firsthand knowledge and experience. A lot of time opportunities miss you completely. Like our friend, the name starts with an R. Like, he was on the Micron trade way before any of us, because he knew exactly where things were going, So developing that core group of friends, that network, dude, I think it's probably been the highlight of my last probably 5 years of investing. And my last 5 years of investing have been the most profitable, because I'm no longer investing based on what I'm just out there reading on Reddit or whatever. Believe it or not, Reddit is what caused me to miss Palantir. So Reddit, I was like going through the red threads, and let me tell you, there's a lot of people that were just saying Palantir is garbage, Palantir is this. And I'm like, their revenue is declining. Maybe that's right. But what do I know about Palantir that I just, and so, it shook my confidence. But the thing is, if I actually knew people that were working in that specific company and, they were actually explaining the acceleration points, I probably would have stayed in it longer. I probably still would have sold, to be honest with you, because the valuation was ridiculous. But I would have at least got a higher level of return out of it. So.
So before we get into some of the software and memory stuff, first of all, the Fed. What was your takeaway from what Warsh said? Do you think we're getting a hike?
It's not necessarily that we're going to get a hike, but I think he's just getting everyone ready and prepared. You know, like the worst thing that you can do to the markets is just basically go out there and say, "Hey, I'm hiking today." You know, you want to give the market a chance to digest the information, process it. But he also was very coy in how he was saying, like, we don't want to give too much info out there, and literally everyone is just basically trading based on this. Like, you know, we want to let the markets do its job. We don't want to manipulate the markets in a certain direction, because when you do that, you have a higher chance of messing things up, right? So like, let's say Warsh comes out and says, "Hey, I think inflation is good to go. We're good." Now what happens? Everyone freaking just loads the F up on debt. They go out there and spend a bunch of money. All these companies spend a bunch of money, and now you got yourself inflation, right? So you don't want to be in a position where, you know, you're being too open about something, even if you feel it, but you also don't want to be like, you don't want to, you basically want to try to ease the market into doing what the market does. Basically buying and selling bonds based on what they're seeing actively in the markets. And I think Warsh is going to be fine as a Fed chair. I do think that there's going to be a lot more uncertainty though, you know.
Why?
It's just his way of communicating. He's more of a market, like, let the markets do its job kind of a Fed chair, rather than
he's not like Powell, that kind of is more explicit in certain areas, right?
Yeah. Like Powell's very like upfront saying, "Look, I think this is what's happening. This is what we're gonna do. Like, we're gonna stay in our mandate." Warsh is like, "Everything's fine. Let the markets do its job. My job is not to basically baby the stock market or baby the bond market. Like, the economy is running okay. You know, the market is." The other thing though is that if, let's say, Warsh was way too adamant on one thing, like you said before, the credibility is in question. By not taking an opinion, he's actually saving his credibility.
No.
You know?
That's fair.
So,
no, and I think the speech was definitely hawkish, but it was not hawkish to the point where he was like, "Yeah, we're going to cut or hike," which is the ambiguity that he loves to have, because he doesn't want the market assuming one thing or the other. And that's where the market can kind of price this stuff in, where if he does hike, it's like, okay, we kind of knew you were going to anyway. So,
you know, I wonder if he was manipulating the algos a little bit. He said hike like so many times. And the thing is, he didn't say it in a way where he was talking about hiking rates. He was like, "I went on a hike with Bernanke. I went on a hike with blah, blah, blah." And I'm like, huh. And I'm like, you know, maybe he's like playing the AI like bots right now that are trading based off information. Like Jane Street just keeps hearing hike, 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 you know, and they're just like buying shit.
Yeah, because as soon as he was done speaking, we reversed pretty nicely across the board.
Yeah. So no, market manipulation is a real thing, bro. I don't care what anyone says. I've been in the markets too long now to not notice it. You know? What about you?
Well, I mean, that goes into this question. Do you think Micron's being manipulated to be stuck at these levels?
No, it's not being manipulated. I just think that it got overbought too quickly. I mean, bro, you had South Koreans turning in their life insurance policies to fucking buy the memory trades. I mean, what more of a screaming top could you get from that? Now, the business is still very healthy. It's going to do really well. It's just that you're not looking at crazy level 5-10% per day moves anymore. You know, you're going to have to be patient. You're going to, like, it's like NVIDIA. You know, last year, NVIDIA got to about 200 something, and then it just kind of consolidated and then made its way up. So if you're looking for Micron to give you a 2X from here, I'm sorry, it's probably not going to happen. But if you're looking at a solid 20, maybe 30%, even maybe a little bit higher for a year, Micron's perfect. You'll probably be okay. There's still a lot of demand.
You don't think Micron 2000 is a thing this year?
It'd be very hard for Micron to get to 2000. You know,
because every price target is still pretty much in that 1800 to 2000 range on the street.
What they can keep it whatever. My price target by the end of the year is like 1250, unless like they come up with some crazy guidance in, you know, in their future quarters where the market just gets completely like worked up. I think that there's been too many people that have been burned by this thing to go in with heavy volume, even if everyone, I mean, the same analysts are saying that, you know, that Nvidia was going to be $300 a year ago.
Yeah.
You know, and it's been stuck at like 200 and 225. So I'd say right now Micron is a great trading stock. Nvidia is a great trading stock because you're getting this volatility premium on the options market. Bro, this is the time to take advantage of that volatility. Sell covered calls. You know, when this thing dips too hard, buy the dip and, you know, wait until it rips. And then you could probably do the same thing over and over again. Like I've made more money. I'm telling you, I've probably made more money than most of our friends who are in the Nvidia trade this year because I've been trading Nvidia back and forth and doing spreads on it.
Okay, what did you think about those earnings? I mean, was there any red flags? Was this like, all right, 70% versus 40% growth? Is this good for memory? Why do you think semis aren't? Like, what was your overall reaction to NVIDIA?
I'd say probably that. Look, I think they're circular financing. I'm not even going to try to sugarcoat it. I think they're definitely doing some circular financing. There's everything points towards circular financing, but that doesn't mean that, you know, it's going to end anytime soon. Like you really have to see that circular financing end up causing a problem, and then you've got problems that come to NVIDIA. But as of right now, you know, everyone is fine. But if you see weakness in the hyper, like the neo clouds, I think that's where NVIDIA's exposure is. And I think that's what could theoretically pop the bubble. So you just have to be very careful. I mean, the comment that I think like took me aback was Nikesh Arora from Palo Alto. Do you know what he said?
Yeah, he said the neo, but I think he's talking about the companies that are raising money right now, not the established neo clouds.
There's only like, 3 established neo clouds, man. Well, I mean, like
there's a lot of small ones that are like, I don't know if he's talking about Nebius or CoreWeave or
no, he I think he excluded Nebius out of that whole thing. I think he was talking more specifically about CoreWeave and some of the other ones. And I tend to agree. I think at some point people are going to wake up to the unit economics of the neo clouds, and they're just not going to like what they see. In which case, you know, the question then the question is going to be like, what's going to happen? You know, to be honest, I think they'll just get consolidated or they'll survive. I would say Nebius probably survives, and some of the other ones, if they drop low enough, they'll be good buyout targets.
Do you think the circular financing is why NVIDIA is getting that 70% growth? Because at the end of the day, Google, Microsoft, Amazon, that's going to be a good chunk of that 70% next year. It's probably going to be closer to 80%. And that's not really circular. That's those companies seeing that they need more GPUs, right?
Yeah. Yeah, I mean, the debate ends up becoming something like the neo clouds are putting in purchase orders, the hyperscalers are putting in purchase orders, but I think the hyperscalers might actually be over ordering. And the reason why I think I think there's I'm trying to game theory this out, and the game theory tells me like if I'm the hyperscalers, I want to make sure that I get a good supply, right? So one of the things I'm going to do is order more in volume because, you know, NVIDIA is going to gravitate towards the person who's buying more in volume, because if you can buy more in volume, you get a bigger discount, you get a better lead time. So instead of saying, hey, I'll buy 100 billion in GPUs, I'll buy, you know, 150 billion in GPUs. But the thing is, that means that you're taking away from future demand possibly. So I think that's a problem. The other issue that you run into is that there are certain issues with energy that is like a hard limit on how much future growth you could possibly have. So what I mean by that is something along the lines of, yes, is there unlimited demand for GPUs? Yeah, but you also need the infrastructure to power this damn thing, right? Like you can't just you can't just buy them ahead of time, let them sit in a warehouse, and then NVIDIA is going to come up with another generation in a year and a half, 2 years. And now the ones that you have are, you know, less efficient than the ones you could have bought on spot in the future. So all of those dynamics are kind of like how everything is being played out. And I mean, we'll see what happens next year. So I think anyone who thought that 40% growth rate in Nvidia was going to be there next year, including myself, we all called it wrong, and we saw that actually demand is very high in terms of the order book. Even without the energy readily available, some of these hyperscalers are willing to, front run this stuff. And I think every single GPU will eventually be used. There is no doubt in my mind that this is not a critical infrastructure item. The question in the future ends up becoming, what is the growth rate that you're going to get out of NVIDIA? And then how much of that growth is going to be translated into shareholder returns? And then what is the multiple that you're going to pay on it? Imagine NVIDIA, this is the same thing that kind of happened with Cisco back in 1998, 1999. Cisco said we were going to CAGR 30% year over year forever. Didn't happen. And when it didn't happen and they had negative growth, what happened to Cisco? Right?
Yeah, I mean, look, if NVIDIA ends up going negative growth, obviously that's going to take a big hit. But it sounds like Jensen's getting ready for a 3 to 5 year stretch where it goes from 90% this year to 70% to 50 to 40, maybe 30 in a couple years out. But it's still going to be massive, massive growth on trillions of dollars of revenue, unless you think the hyperscalers are overbuilding right now.
I don't think Jensen has a choice, because Jensen, clearly, if you were to leave it up just to market forces, you wouldn't get this much demand. Why? Because the neoclouds and these other builders wouldn't have the money. So NVIDIA had to step in, right?
Obviously, yeah.
So the debt markets right now are actually screaming the exact opposite, saying, hey, listen, there's more risk on the table than the market thinks. So, I want to buy $100 million apartment in New York City, but if I don't have someone to load me that money, I can't buy it, right? So the neoclouds are in the same place where I think
the question is, if someone gave you $100 million to buy that New York City apartment and you flip that apartment for $150 million, right?
Yeah.
The neoclouds flip those loans of the GPUs they bought for more money. That is what keeps, whether it's a circle or not is whatever, but that's what keeps the cycle going.
Yeah, of course. It's the day when the neoclouds cannot support the system anymore. That'll be like a first chink in the armor. And then you've got Oracle. Oracle's running into financing. They're not running into financing issues per se, but their bonds are trading at near junk at this point.
Yeah.
So a lot of people are doing the math and they're just saying, it's not that we don't find this an attractive return, but there's just so much uncertainty in the future that they're not sure if the ROI makes sense. The other problem that you run into is that, everything is about risk. Imagine tomorrow morning, China releases some kind of model that's 10 times more efficient than Anthropic's and OpenAI's. And all of a sudden now, our labs go out of business. It's very rare, I think, based on what we're seeing right now, but it's a possibility. That's why the DeepSeek thing happened. So I think what it is just the market is
all of those are reasons why this stock is basically stuck after earnings, right? It's down 2% today. The risks you're highlighting are very real, and I think the market believes in them as much as we want to believe that this thing should be trading at 250, 270.
I think the problem with NVIDIA is that if it wasn't for the circular financing deals and you just had raw people buying GPUs, NVIDIA would be at 300 right now, because that means that there's genuine demand and it's not creating that seller financing kind of backdrop. Right now, if Jensen said, listen, everyone, there's just so much demand out there, we can't keep up with it, and we're not financing anyone, everyone is just buying their own shit.
Yeah.
You would not have NVIDIA trading at 220 right now. That shit would be 300 easy. But everyone is looking at this and saying, if Jensen has to finance all of this stuff, how durable is this business model really? Now, Jensen is making a bet saying, I think that there's value in the neoclouds. I think that they're going to be vastly more profitable than people think. And I think the money that we're investing in these guys now is actually going to pay off for us. So who do you believe in this case? Do you believe the market or do you believe in Jensen?
Well, who do you believe?
That's probably a combination of both. It's always I'm always the guy in the middle, man. I think that there's a ton of demand out there that's not getting fulfilled. But the reason why there's a ton of demand is because OpenAI and Anthropic are basically subsidizing the cost. And the thing is, if you took away that subsidy, if let's say Anthropic and OpenAI were just charging full freight everything, I don't think there would be nearly as many people using AI right now. You know, like what's his name? Steve uses Claude like there is no tomorrow. Claude, you know, Fable, what is it, Fable 5? He uses it like there's no tomorrow, but that's because he only has to pay $200 a month. If he had to pay the full API price on what is that thing called, on Claude, I'm not sure that, you know, like he would be using Claude as willy-nilly as he is right now. I mean, I'm talking about this guy is like George Washington's birthday. He'll ask like Fable 5. He's like, it's not my problem. I don't care. I don't care if it costs 1 million tokens to find out what 2 + 2 is. You know, like, so.
Yeah, look, I think that's fair. And obviously the large language models are subsidizing the cost for all of us. The sort of core business logic is, hey, we subsidize the cost, we get all the users, they get hooked onto the product, eventually you figure out the business model. I think there is a very valid critique around OpenAI and Anthropic. I think that's fair, especially as they get ready to go public, seeing what these numbers look like. Does that mean the broader demand cycle isn't there for AI in general? I don't know if that's true, but you can't not acknowledge the fact that OpenAI and Anthropic are a decent chunk of that RPO. And that's going to be an experiment going into this Anthropic IPO when we get the S1 on September 7th.
I think AI is very real. I think AI is going to be with us forever. Like, there's no getting around it. I think AI is a part of everyone's life now. The question is, what is the speed of the dispersion of AI among the rest of the population of the planet? And what kind of value are people getting out of it? I get a ton of value out of the LLMs, but I've realized that the best way I can utilize them and harness them is by asking the right questions. And so that's the thing that I'm learning. I'm learning how to prompt these things so that I get a more accurate, concise answer that I actually need that doesn't come with mistakes. Because the thing is, like, if you ask a question that's loaded with a bias, you're going to get a biased response. But if you give it like a very neutral kind of like signal, it's going to give you a very neutral signal. Now, the key to the SaaS vendors and why the SaaS guys are doing so well is because the SaaS guys all have so much of that proprietary data, they can actually tailor commands that ask the relevant question, right? So as an example, let's say you have Palantir Foundry.
Real quick, before you continue, for those asking why are semis going red, I think this is a little bit of a delayed reaction from Warsh's speech on the 10-year as it officially crosses 4.71 again. And, you know, growth stocks, especially semis, don't really like that. So I think that's why we're going red right here. Go ahead, Chris.
Yeah. No, I think, so like, let's say you're a software company, you've already got a relationship with a customer, right? And you want to basically integrate LLM features into that company. Well, you've got this business with all of this business logic that's stored on Foundry via its ontology, right? I'm sure that if you used a question like a person just asked Claude or, you know, or one of the other LLMs a question without that business logic, it's going to give you a biased answer. But if you give it, you know, like you layer the two together, what happens is that software product is actually going to ask a way more detailed question, and it's going to ask it in a way that there's less biased responses that you're going to get out of it. And then you're also going to be able to layer on a whole bunch of features and all this other stuff. So I'd say that's where we are with this, where I think SaaS is partnering with the model companies, and we'll do good.
What did you think of? And by the way, guys, 60% chance now for a rate hike. So for those wondering why we flipping red, you know, we flipped really green after Warsh stopped talking. But at the end of the day, if the 10-year gaps up, it's tough for stocks. NVIDIA now down almost 3% to kind of hold on to their momentum. What do you think about Dario and Benioff together? Because I thought that was interesting. Dario kind of acknowledging we need Salesforce's contextual proprietary data. Salesforce, I think, trying to get the market to be like, look, they love us. They don't want to kill us. Do you think that is part of the way that Anthropic will survive, by partnering with these really big enterprise companies and working with them long term?
Before I came on this, I was thinking about how to best analogize it so people could understand it a little bit in like layman terms. Imagine right now Anthropic has just come up with the best sauce on the planet. Like every sauce that's on, that currently exists is subpar compared to what Anthropic has. Now, the thing is, Benioff owns a chain of pizza stores, right? All over the country, he has a bunch of pizza stores. Everyone already knows it. Everyone eats there. Does it make sense for Anthropic to say, you know what, I'm going to build out that infrastructure. I'm going to build pizza places everywhere. I'm gonna hire delivery drivers. I'm gonna do marketing, all of that stuff. No, it doesn't make sense. A lot of times it's just like, hey, let me just work with Benioff. Benioff already has that relationship with all the customers and clients. I'll sell my pizza, like my sauce, to this guy, right? And he'll take care of all the other stuff. So now you go into the easiest business model there is to understand. You buy wholesale, you sell retail. Salesforce is going to buy tokens from Anthropic, right? Wholesale. They're going to sell to their customers retail with the software licenses layered on top of it. So you get a hybrid model. So that's it, So it makes more sense to partner with the SaaS companies. And if you go to this tweet that I had with Chamath, he actually explained it pretty well in that the goal right now for Anthropic and OpenAI is to get as much dispersion out as possible, to get their models to be like the default everywhere. And what better way to become a default than being integrated into a product that's everywhere right now?
Yeah, no, I think that's very fair. I think that's why the software names are winning. Here's a better question then. Do you think software has a good risk reward now that it's made its move?
I mean, the first thing is the multiples were trading at like historical lows. Even the companies that were still like maintaining their growth rates, they were getting hit just as hard. So if you look at like ServiceNow, their growth rate has not dropped nearly as much as like some of the other companies have. So, if you can maintain a 20% growth rate with ServiceNow, you're fine. You should be getting a better multiple than a company that's, at a much, much lower growth rate. But they were trading at the same thing because everyone just said, oh, this is the SaaS apocalypse. Everyone sell. And clearly that wasn't the case. And so a lot of those multiples are resetting back again. ServiceNow, I like ServiceNow's management in that they realized that cybersecurity was going to be a moat that a lot of people were not appreciating. And so they made it seemed at the time that they were overpaying for Armis, but it ended up being something that worked out in their favor because after Fable 5 Mythos, cybersecurity became like the new hottest thing. So not only will ServiceNow be able to sell their ITSM products and then also layer on a whole bunch of AI features, but they're also going to be able to sell cybersecurity on top of it. They've got a knowledge graph on everything. So you can't just let the LLMs run wild. You kind of need like a control plane everywhere. And that's what ServiceNow is doing. And so,
but would you buy the software names at these multiples right now if you didn't have a position?
I'd probably
I think the answer is no. Like ServiceNow at 140, your upside is not like it was at 80 at this point.
I would buy the stock. I wouldn't do options on it. Like ServiceNow when it was 80, the options were just too attractive because you were just getting so much more downside protection than before, right? So if you were asking me like, hey, what's the goal now, Chris, for the software companies? I'd say, okay, I think now they can compound. They can compound at their usual 10, 15% growth rate going on from here. So if ServiceNow is at 150, I think by next year it could be like 175, maybe even 200, right? Which is not like, oh my God, it's going to change my life money, but it's good, I think the problem is so many people want to basically have the 5Xers and they just want to ignore the market performers. Now, if you can get a 5X out of software, but you got to time it so that you're buying at a bottom and you're layering on like a lot of leverage through options. If you do it, you'll get a pretty outsized return. So
you have Iren in the stock draft. I don't know if you took a look at the earnings, but are you disappointed?
Bro, that was a mistake. That was a mistake. I'll tell you, I'm not even sugarcoating it. Chris did shit wrong, and I got Iren wrong. Okay. You know who screwed me on it? Claude. I actually tried to.
You bought it because of Claude?
I did buy it because of Claude. I could tell you my search history too. I was like, who is the most underappreciated what is that thing called? Neo Cloud that has the most energized power. So IREN does. IREN has 5 gigawatts of energized power. And I'm like, shit. Everyone is screaming at the top of their lungs that they just need this energized power. That means IREN should be fine. So I fucking bought IREN. You know. Look, I'm human. I get swayed by arguments just as much as everyone else does.
But did you care about the earnings? Did you see what they said, or are you just like this? There's nothing here that's exciting.
I think management's a little. I don't know. I'm not feeling management, but what do I know?
Okay, that's a fair point. Bitcoin 78.5. So software's long, Nvidia kind of watching how the market thinks of the circular findings and stuff, and then memory, you continue to believe that this is the best. So okay, if you're concerned about circular financing with Nvidia, why does it make sense to go long memory here?
Because there's a crap ton of demand for memory. And the thing is, if the financing is already there, but Micron's not layering on, Nvidia is layering on circular financing debt. Micron is not. Micron
no,
is
but hold on, Chris.
Yeah.
If Nvidia doesn't do the circular financing, all these neoclouds can't buy the chips. The inside of the chips is the memory. Like
right, but the memory is not a risk. Memory is not like Micron is not at risk right now to have to pay out all of this money to the neoclouds and all.
But neither is Nvidia really. It's not really a liability.
I mean, it's on the balance sheet. It's gonna have to be on the balance sheet at some point. You know, it's going to decrease over time.
I get your point, but if Nvidia didn't do the circular financing, one could argue that memory demand would slow down because memory is in the GPUs at the end of the day, right? The GPUs are being sold.
Yeah. I'll be very transparent. This is a trade for me. Okay, I think by the end of this year, I have a certain price target, and that's it. This is not like Chris's long-term bullish on memory. I just think that there's a lot more visibility that Nvidia just gave us when it came to how much these guys are charging, and I think that is going to be a catalyst for a big earnings surprise for a name like Micron. In which case, Micron should shoot up. You know, I'll be honest, I have no qualms about like, oh yeah, I'm going to buy Micron and hold it for the next 10 years. Like, I'm not in that camp. I'm in the, hey, listen, the market overbought this thing. Then it really, really overshot the selling because of Leopold and all the leverage being, squeezed out of it. Now it's a good opportunity for a nice bounce back, And like I said, if you're looking at Micron to do like 10, 15% year over year, like return in the market, like, in terms of their stock price, I think you're fine. But if you're thinking Micron is somehow going to escape the reality of the cyclical past behavior and the market is just going to overlook that, like, no, there's still a lot of people that are scared that the memory cycle is going to come. And so a lot of people are going to say, I'm not going to pay a significant premium for it, even if they see the growth.
Right.
Because they don't trust the growth.
All right. That is what we got today, folks. Chris, thank you for joining. And first of all, congrats to Chris as well. He just bought a house. So
thank you.
Awesome
Come
stuff.
Through, man.
First house.
Come through.
I'm excited. I'm excited. I'm assuming ServiceNow spreads going up makes it easier to be excited.
I'm telling you, we need to buy a townhouse, man, in the city. Come on. I'm hearing good things about the city. I'm hearing that there's a lot of tech companies moving back to the city. Look at SLG. Like, they've been on a tear, dude.
Oh wow.
I completely missed SL Green going up. I've been too focused on everything else. Look at that thing.
Yeah. No, it's made a move.
So SL Green is the largest commercial like office building provider in New York City, and so they've been rocketing higher, man. So New York City is back, even with Mamdani.
And who knows, man? New York real estate is always a good bet, right?
Yeah,
it's never bad to own more real estate.
Someone said a good question. Chris is from Atlanta. Why are you owning a townhouse in New York City? I'm actually from New York City.
Chris wants to come back to New York, dude. I've been trying to get him and Matt to move here. Could you imagine all four of us in the city? But he won't do it.
Get a townhouse, and I'll consider it. There you go.
Oh,
come on, man.
The wife, you would have to get the wife on board too. It's not easy.
No, I'll fly. I'll fly back and forth. I don't mind. It's only an hour and a half flight. The airport's not that far from me, and there's like 20, 30 flights a day between New York and LaGuardia. So.
Sounds like a myth. You live in New Jersey, dude. It's a 20-minute path to New York. I'm a New Yorker.
Nah, but you can't drive into the city without that fucking tunnel, though. That hour and a half long tunnel. You know, I broke up with a girl because I couldn't deal with the Holland Tunnel.
That's
My
a fair
ex
reason to. I get it. That's fair.
I was just like, I can't do it, girl. I'm sorry. Like, this is just not gonna work. I can't deal with this hour-long tunnel traffic every day.
And the wow, Rocket Lab is about to lose 64. The polls, the tolls on the Holland Tunnel have increased a lot since you used to take it every day.
What is it now?
I go through the Easy Pass, so I don't really know, but it has to be like $8.60 or something roundabout.
Okay, yeah,
$8 roundabout.
There, man.
But if you're coming from a different part of New Jersey, it's like around 16 to 20.
Yeah. I think which one is free? Is it Lincoln that's free, or is it one of them is free? You can come up through the Battery. You can come through the Battery Tunnel too, but that lands you in Brooklyn. So
yeah.
Would you consider that? Like, are you considering? Like, I know we spoke about it that you wanted to move to the city.
I'm considering it in next year. No, not next year. 2028.
2028.
So, yeah, definitely not next year, but 2028 for sure. Because I'm in there. I'm in the city like 4 times a week at this point. So
yeah, I was gonna say it's just, hey man, come on, don't you want to like date some chicks out there? You know, having your own place in Manhattan. I'm telling you, that's what worked for me. That's how I got my wife, right, honey? Yeah, I know. I gotta get ready to go. Yeah. What does Steve call his wife? The shadow government. Yeah, no, I don't.
He could keep me if he buys a brownstone.
Ooh, okay. So see, she's on board already, and we'll get you some real bricks. Some real bricks this time. Later, guys.
All right, Chris. Thank you. Later.
Okay. Bye.
All right, guys. Unfortunately, the rug pull is here. It's about an hour late. It's supposed to happen at 10:30. It's happening at 12. For those in the chat that said there's going to be a rug pull, there it is. SPY is 3 cents away from going red. 775 was the fake out. SPY goes red. CoreWeave red. NVIDIA red. Micron red. Nebius, ugly red 5. AOI down 6. Rocket Lab, this has been a disaster of a stock the past couple weeks. I would imagine around this low 60 range it could try to bottom, but if it doesn't, it is what it is. SpaceX loses 140. I mean, the fact that ServiceNow and Microsoft and Palantir are still green is actually pretty freaking impressive on a day like this. Even Palantir, though, losing a good chunk of it. It was at 188.30, now at 186.39. Microsoft at 514. Amazon was at 267. Amazon at 265, but at least that's still up 4%. Everything else getting the flip. I mean, this is the reaction I think most people expected to Warsh's speech, to be honest. Now, the counter opinion here is that it's priced in so the market can move on, which is fair. But the market pricing that in within 20 minutes of his speech is not usually what happens, but sometimes it does. So you can kind of use that logic to move forward. But over the coming weeks, pricing that in makes more sense. The fact that they're selling it off means that the market's obviously not ready to easily price it in, because at the end of the day, the risk of a hike is still a risk, nonetheless, that the market will have to deal with. NVIDIA potentially going to lose 220, which would take it well below that high that it had yesterday at 230. So that's what you got, folks. That is what you got. Obviously a little ugly after Warsh, kind of expected given how hawkish he was. You got the pump fake for about 45 minutes before. And look, maybe by the end of the day this flips again, but you know, once momentum is lost, it's tough on a Friday out of all days when options are expiring for it to come back. And so we are going to have to see. Fear and greed, that's a good question. Do we get neutral? We got neutral. Yep, 55. We are not in greed anymore. We are neutral officially. Fear would be probably another 5 or 7 points, which means we would have to go down a bit on the S&P, but we are not in greed anymore. You could argue the speech was convoluted and the market took time to dump. Yeah, because again, as Chris said, you know, him saying hike over and over and over again definitely got the algos moving in different directions. But then some statements were bullish, some statements were bearish. It overall came together from my perspective as a hawkish speech, but nonetheless a speech that inevitably the market's going to have to price in forward if we do end up getting a rate hike. All right, word of the day, and then we will be done for today. Again, we're not doing a market close, just having an extra long market open. Let's pull up this word of the day, see what we've got. It's been a long week. We are losing strength. He did say strength, and I didn't hear a G. I don't know if you guys heard a G, but I didn't hear a G. It felt like legit strength without the G. So I think he was stealing my jokes. He's stealing my lingo. I think Warsh and I have a bit more in common. But yeah, crazy week. NVIDIA earnings, overall good week in regards to a lot of the macro data and the earnings data. And now we end out August on Monday and we head towards September and see if we can get to the end of the year without a ton of volatility coming into the system. Word of the day. Word of the day. I did not hear the G. I don't know why you guys acted like he said the G. Perpetia. A sudden and dramatic reversal of circumstances, especially when events abruptly turn in the opposite direction. The earnings report triggered a Perpetia. The company went from market darling to cautionary tale almost overnight.
Peripetia.
Okay. Peripetia. That's what I said. I just said it in a way that didn't sound like I said that. Peripetia. Obviously, the E before the R. Peripetia. That is what you have on our word of the day. Markets are full of peripetia. Dominant companies stumble. Hated stocks recover. Narratives reverse. And yesterday's certainty becomes tomorrow's consensus. That's Shamat's last name. That's crazy. That's crazy. You know what Chamat's last name, Polyhopatia, reminds me of? This is so random, but I thought about this the other day, but I never said this. At the old house we lived at for like 15 years, there was a Wi-Fi password. Okay. And this Wi-Fi password, I don't know how I still remember it, but I still remember this Wi-Fi password and I can recite it letter for letter. Okay, ready? PPHFLN5NWB3QZSJ6. Like the other day I was thinking about it, just randomly. I'm like, how do I, because I typed this Wi-Fi password into like a billion times when we had people come over the house, because that was our first house we lived at for like 20 years. And it starts with PP. So I thought of like Polyopatia, this word of the day kind of triggered it. I'll say it again. PPHFLN5NWB3QZSJ6. That is crazy, right? That I can say that off the dome. I'm not reading anything. I would close my eyes. PPHFLN5NWB3QZSJ6. That's insane. That is insane. Like, I can't believe that's in the back of this random stuff that's stuck in your brain. I'm like, how did that get stuck there out of all these years? But yeah, that was my old Wi-Fi password. So that's it's I can't say the word strength, but I can remember this like convoluted Wi-Fi password from years ago. But yeah. Now everyone starts typing in their own Wi-Fi password. That's a complicated path. That's not like 1, 2, 3, 4, 5. That's like an actual, like, go reverse and listen to what I said. That's like a string of letters. That's not easy to put together. This is your superpower. Yes, speaking is not my superpower, but this is. Harvard waitlisted you because of that. Anyway, that's what we got. Thank you all for being here. I will be back on Monday for the market open. We will be in September on Tuesday, which is just crazy to me how quick this year is going, but it is almost 2027. And, excited to be covering the markets every single day with all the different things that we have. The fact that Warsh talking had all of us glued to every last syllable of what he was saying just shows how much we care about this, how much it's become a sport, and quite frankly, how much, we all rely on each other to kind of make sense of everything that's happening. So deeply, deeply appreciate you all. Thank you all for being here. Meant the world. I will see you guys on Monday. Have a great, great weekend. And we'll be back and we will be analyzing markets going into September. All right. Thank you, everybody. Appreciate you all. I will see you guys Monday on the market open. Make sure you enjoy your weekend. And, if you go to the gym, you engage in strength training. And, you remember your Wi-Fi passwords and you enjoy your life. That is the goal of a MIT viewer, to make sure that they have strength They remember their Wi-Fi passwords, and they listen to Bohemian Rhapsody. That is a complete weekend. All right. Thank you, everybody. Appreciate you all. See you guys on the Market Open on Monday. Bye, everybody. Have a good one.